AI bullishness is there. I don't think that has changed.
Technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter.
We've obviously had a long streak of really very little volatility.
This whole rally has been fought.
The S&P is not the same as it was 25 years ago.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, we have a deal.
I just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. They're top people here, and it's a great deal for everybody. We're doing things that have never been done in this country before, and our country is becoming very rich again.
Japan and the US striking a trade agreement, sending Japanese equities higher as Elon Musk's Tesla prepares to report results following a Q2 storm. Alphabet is on a 10-day winning streak heading into Max 7 earnings. It's risk on this morning.
And is it in spite of the tariffs that we've heard announced, or is it because we've heard some announcements around what those tariffs could be, given the fact that we have some certainty? When it comes to big tech, it's been in spite of tariffs because this has been a more tariff-protected industry and one that's had a secular tailwind behind it. The rest of the index, though, at automakers, why is it suddenly that 15 to 20 is the new 10, and that's fine with markets, and that seems to be where we are?
The bad news is it's 15%. The good news is it's not 25%. That seems to be the takeaway for markets at the moment, and maybe what we've just agreed with Japan, we can agree with the Europeans and move on.
Well, this to me is fascinating because everyone said maybe 4 months ago, 10% we can probably handle. Anything above that, it's game over. You have a real deficit to profitability, and it creates some real headwinds that are structural and potentially inflationary. Now, all of a sudden, 15 isn't 25%. You said this before. If you benchmark to the extremes, everything looks great, and it seems to be where we are. At what point do we start to see it, though, play into the earnings in a way that is sort of deleterious? We haven't seen it so far, and that is kind of the amazing thing, even with General Motors yesterday.
Before we talk about U.S. equities, we'll get to Alphabet and Tesla later in the program. We've got to talk about Japan. The eye of the storm. 3 issues: trade, the future of the Prime Minister, and debt auctions, your favourite. Because equities, bonds and foreign exchange are moving in different directions this morning. Big rally in Japanese equities, got that. But check out bonds. Yields up again. The grind hard continues.
There was an auction of 40-year debt overnight, and it was the poorest demand for that particular denomination going back to 2011. And you see the yields on that denomination at record highs. You have yields on 10-year Japanese bonds, the highest levels since 2008. Why? Because you have the potential rumors around Ishiba, Prime Minister, stepping down. He has denied these claims, and we'll get into that. But there's a feeling that this desire to continue spending and to cut taxes in the face of that is adding an extra layer of noise around a bond market that already has struggled with a little bit more of an inflationary backdrop, and frankly, a country that's required to borrow more to fund some of the initiatives they just agreed to with the United States.
Bond yields high this morning by 8 basis points over in Japan. Stateside equities up by 0.4%. Coming up on the program this morning, keep it right here on Bloomberg Surveillance. Next hour, the Treasury Secretary Scott Bessent, plus the Commerce Secretary Howard Lutnick, and later, the former ambassador to Japan, Senator Bill Hagerty. We begin this hour with our top story. President Donald Trump striking an agreement with Japan that will impose 15% tariffs on imports. With the latest, joining us now is Bloomberg's Annmarie. Annmarie, we have a deal.
We have a deal when it comes to Japan. Remember, this was a country that everyone thought immediately out of the gate there would be a deal. They had to go through a number of negotiations, and the president himself last night holding court in the Oval Office with Japan's top trade negotiator, 75 minutes. They were talking and getting through the final details of this trade agreement, what we have in principle right now. Of course, there's going to be a number of details that need to be worked out for a full agreement. But across the board, we were looking at a 15% tariff rate. Now, this is higher than the 25% the president sent to a letter earlier this month to Japan. It is, lower. It's also lower than the 24% he said on April 2nd on Liberation Day, but it's higher than the 10% that Japan was getting most used to. What is critical for Japan in this negotiation, though, is that the 25% auto levy on autos and parts comes down to 15%. That is huge for them. For the United States, the president says Japan is going to open their markets to things like autos, to things like rice, as well as Japan investing more than $500 billion into a fund into the United States. What's really critical for me today, seeing parts of this agreement the president announced last night in his Truth Social post, is that does this set the tone, as you and Lisa were just talking about, for the remainder of these trading partners that the Treasury Secretary told us last week, like the European Union, that were dragging their feet?
Begs the question. For the EU, they were ready, prepared to accept, reportedly, a 10% tariff. Are they ready, prepared to accept the 15 that Japan's about to eat?
I think they're going to have to be prepared to accept that, because why is the president going to be willing to come under 15% when Japan just accepted that, when Japan has a tremendous amount of exports going into the United States, especially when it comes to the auto sector? So that's going to be a key question for Brussels. They have to decide whether or not they want to take the chance of going at this to August 1st, that deadline, and then potentially getting into a wider trade war with the United States, or, as you say, Jonathan, eat 15%. They weren't out of the gate like the United Kingdom, which got 10%. They might get stuck at 15 or risk going higher.
Annmarie, stay close. Annmarie in the nation's capital throughout the programme this morning. That auto sector, that sector accounting for 1/3 of Japanese exports to the United States.
The fact that those shares are absolutely flying. Toyota up something like 16% on the prospect of just 15% tariffs tells you everything about where expectations have been and how different it is this time around.
Here's the view on Wall Street this morning. FOMO is back. Julian Emanuel of Evercore is pushing back. The next 7 to 15% is down in the S&P 500 at nearly 25 times earnings. Prices have over-discounted continued good news on trade and earnings at a time of year where stocks tend to weaken. Julian joins us now for more. Julian, good morning.
Good morning.
That deal, does it change anything?
Well, so here's the psychology. It's interesting. Of course, we know that markets prefer certainty. That's an almost, given. But I think there's been this psychological benchmarking around the 20% that people associate with Smoot-Hawley, right? So something comes in well below that 20% number, and markets think, okay, we can live with this. But again, I think, and we were talking about this earlier, is that part of it is that for a variety of reasons, we have yet to see the actual effect of tariffs. Particularly the inflation numbers really just starting to feed at some of the sub-indices, and we still think that's ahead. And so sort of putting that all together at this valuation, which is the highest basically outside of the dot-com boom and bust, we think actually a pullback would be healthy.
Raises the question, just how high is the bar in the second half of this year? Because we hear a lot of people talking about a second half rebound, and never mind a second half rebound, they're looking out to 2026 and beyond, looking for earnings to accelerate from there.
Well, and there's certainly a case for earnings accelerating, but right now, when you look at bottoms up consensus projecting a 13% increase in 2026, those are the kinds of numbers that you tend to see coming out of, real economic trough type conditions, which clearly we don't have. And from our point of view, there is an informative lesson going on the last couple of weeks, and we think, which is why today's earnings begin to be important, is that the price reactions are very mixed. Essentially, there's an element of, good news being in the price on an individual stock basis.
Just to build on that point, how different are today's earnings, Alphabet and Tesla, from what we've seen already, given the fact that they're in the technology sector and they're built on the promise of innovation that might be slightly different than some of the bread and butter consumer-facing stocks that we've seen so far?
No question about it. And I think like you look at the dichotomy yesterday of, better than feared earnings out of the home builders, massive surge in those stocks. And at the same time, the semiconductors really acting very poorly. But we have to remember, the semiconductors are up 70% off the April lows. A lot built in. And when you look at these reporters today, and of course, both have idiosyncrasies around them, it's more a reflection of mood and positioning. And from our point of view, again, coming into what is typically a more challenging point of the calendar, August into September, we do think there's a case to be made for just sort of this pause.
Someone didn't tell the Reddit traders. And this is something that we were talking about yesterday with Alex Altman of Barclays. And then overnight, people really pointed to Open Door, as well as Kohl's. Suddenly, this chain out of the Midwest that sells discount clothes is absolutely the most exciting stock out there for a lot of people who are looking to replicate the GameStop kind of thing. I'm just wondering why you think that isn't enough to keep the FOMO trade going, even though there might be these questions around valuation.
Well, it clearly signals that something has changed. And frankly, we wrote a note over the weekend that pointed to the fact that a number of very seasoned investors who were running money in and around the dot-com boom and bust asked us the question, is it different this time? And that was sort of the trigger point. And then obviously we walk in this week and we see, tickers like Woof and as you pointed, all of these things really acting as they did in 2021. And it tells you the mood has changed, speculation has advanced. But I would remind people that similar to the meme stock moves in 2021, it didn't continue moving in a straight line. There was lots of volatility in and around, particularly when those stocks unraveled.
The numbers that came from Alex Altman of Barclays yesterday were just amazing. Just one day last week, 11% of volume across 4 names, which only account for 2.6 basis points of total US equity market cap. These stocks aren't a big deal compared to the overall market cap of the US. And I often say when we have moments like this, that just because you found a casino doesn't mean the whole place is Las Vegas. What about the valuations of the companies that actually make up the bulk of the S&P 500? What about the earnings that those companies are delivering right now?
Well, again, we have no quarrel with the earnings at all. And in fact, it was our view coming into the earnings season, there seemed to be a little bit too much caution, I think, around earnings. And our work led us to believe that you'd be, high single digits verging on 10% growth. And that's how it's shaping up. It's less about the present earnings and more about the effect of the future earnings and the fact that there is this over-optimism at numbers, again, as I said earlier, 13% growth in 2026. It's just a tiny bit over the skis at this point.
We might have more visibility on what the levels of tariffs will be, but Texas Instruments yesterday I thought was really interesting. They said, yes, we might have more certainty around tariffs, but we don't know how much of a pull forward there was. We don't understand how this is affecting our business and what this means for how we project going forward. How damaging would that be to valuations if you heard something similar from the likes of Google or even Tesla?
Well, it certainly would give pause. And again, in a FOMO market, it may give pause for a half an hour or a half a day. But broader picture, again, going back to my original comment that markets like certainty, the converse is that less certainty is certainly something that at this valuation is likely to be discounted. But again, it's a reflection of the mood that there's as much angst around that kind of report, given the fact that the semiconductor index is up 70% from the April lows.
Apparently they like certainty, but they don't like honesty. On a conference call, just turning around and saying, we don't know. Of course the CFO doesn't know. But apparently that just instills the fear of God in equity investors, and that's the move we see in Texas Instruments overnight.
Well, to me, that's sort of shocking, right? Because at a certain point, how could they decipher from their thousands of customers which of them are bringing forward demand? How could they know with any kind of certainty? But it highlights that, do we really have the certainty that many people expected to have? Yes, we might have the rate, but we don't understand the adjusting and how companies and consumers really handle what these extra charges look like for their businesses.
Julian, it's good to see you. It
Great
always is. Thanks for being here, sir. Pushing back against some of the FOMO out there at the moment. Julian, Emanuel of Evercore. Equities at the moment positive once again, adding some weight to the rally. All-time highs once again yesterday, again this morning on the cards at 9:30 Eastern time when this market gets open. Let's keep an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Good morning, John. We start with our top story. President Trump announced a trade deal with Japan. The agreement imposes a 15% tariff on imports and creates a $550 billion fund to make investments in the U.S. Japan also agreed to buy 100 Boeing aircraft and boost its purchases of rice, plus increase its defense spending with U.S. firms. Meanwhile, Treasury Secretary Scott Bessent offered support for Fed Chair Jay Powell a day after calling for an exhaustive review of the central bank's operations outside of monetary policy. Bessent says he sees no reason for Powell to step down amid President Trump's criticism of the Fed for not cutting rates. And Morgan Stanley is being investigated by the Financial Industry Regulatory Authority over its vetting of clients for the risk of money laundering. The Wall Street Journal reporting the investigation is focused on clients, risk ranking, and other practices. The bank has been working on fixing its client screening practices after the Federal Reserve for years raised concerns. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, striking a deal with Japan.
I just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. We worked on it long and hard, and it's a great deal for everybody.
Up next on the program, the former senior White House trade advisor Kellyanne Shaw, live from New York City this morning. Good morning. It's the rally this morning. Futures positive by 0.4% on the S&P. A test for the Nasdaq later. Alphabet, Tesla, the Russell outperforming up 1 full percentage point. But if you want some real outperformance, check out Japan. Japanese equities rallying hard. Toyota up 14% for that stock in Japanese trading today. The biggest one-day gain since 2008. At one point, it was the biggest one-day gain since 1987. Coming to an agreement between the US and Japan. This sector, the auto industry, accounting for 1/3 of Japan's exports to the U.S.
So is certainty enough, right? Is the idea that you get 15% tariff and you don't have a 25% or potentially higher tariff enough to generate this type of gain in terms of market share, in terms of sustainability? Or is this just the fact that people are cheering around the idea that they can handle something and they have to wait to see the ramifications? Ultimately, we'll see, because I really do think the stark difference between the certainty of the tariff rate and then the uncertainty of exactly how it's going to play out in customer demand that we've seen in some companies is going to clash at some point.
There's a bit of tension between two stories. You mentioned Texas Instruments down hard on the uncertainty in the back half of this year, the lack of confidence guidance. They're quite dependent on what happens in the auto industry. At the same time, you've got Toyota rocketing over in Japanese trading.
Just because you know the rate doesn't mean you understand exactly who's going to pay it and how that's going to influence customer demand. And that, I think, that uncertainty is going to play out in earnings, or maybe they'll just lie. Because ultimately, if you lie and you say you're certain, you probably will do better in terms of your post-earnings performance.
Just be hopeful. I'm not saying lie. Just be hopeful, as opposed to being
What's
cautious.
The difference? Sorry, carry on.
A top story this morning. Under surveillance, striking a deal with Japan.
I just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. We worked on it long and hard, and it's a great deal for everybody. It's a great deal. A lot different from the deals in the past, I can tell you that. We're doing things that have never been done in this country before, and our country is becoming very rich again, and that's the way it should be.
Here's the latest this morning. President Donald Trump announcing a trade deal with Japan, imposing a 15% tariff on imports and creating a $550 billion fund to make investments in the U.S. With the latest, here's Annmarie. Morning, Annmarie.
Good morning, John. And I'm back with a guest who had told us a few weeks ago, take a few days off. All those letters going out were consumption for those trading partners, not for us, not for the markets. Kellyanne Shaw, former U.S. senior trade advisor under Trump 1.0. Thank you so much for joining us. So what do you make of this deal when it comes to Japan? We had the Treasury Secretary join us last week. Then he went to Japan, said he was going for the expo. He clearly met with the prime minister. And now last night, the president holding court, able to get it over the finish line.
Yeah, it was quite the surprise. I was actually out having a nice dinner with colleagues when the announcement came and had to politely excuse myself. I don't think anyone was really expecting this deal to come together as quickly as it did, because negotiations had been so fraught and so challenged for weeks. But clearly this was a leader-to-leader decision in terms of the president being right there with Japan's lead negotiator in the Oval Office, squeezing Japan for every last drop in terms of these large investment figures, taking that what we thought might be a 10% tariff, moving it up to a 15% tariff, and then striking a deal on auto. So this is classic Trump, his style of negotiation. And it was a very unique way for this deal to come together, but it finally did.
You actually saw the president get those last concessions on Twitter, because an official posted a photo where you see a Sharpie block out the $400 billion of the original deal and put $500 billion, and as well as for the tariff rate. Why was Japan willing to give in at that last moment as well, go to 15%, not 10, and even invest another $100 billion.
Yeah, well, I think some of the writing had been on the wall. We've seen over the past few weeks the president become increasingly comfortable with his tariff policy. The market was doing well, inflation was not rising, good job numbers, and this idea of pushing countries beyond this 10% baseline, which had been in place for several months. I think Japan saw the writing on the wall that it was likely to get something above that 10% baseline, so that's why they ultimately conceded. But you have to also take into consideration what was happening back in Tokyo and in Japan in terms of the elections, in terms of potential rumors of the prime minister resigning. I think that this is a big win for him. And so that was part of the dynamic, and the president took that moment and seized on it.
Two signals I want to take from this. One, what does it mean for the EU? Is that a signal that they can't get below 15%? And also the auto tariff, 25% for everyone else, but Japan's getting 15%. Do you see the direction of travel of everything really leveling off now at a 15% rate?
Yeah, I actually thought that 15% auto tariff was a big concession in terms of the White House, because previously there had been talks about limiting auto imports to something like a TRQ, a quota, kind of like what we saw for the UK. A specific amount receives a lower tariff and everything else gets tariffed higher. In this case, it's 15% for everything, no matter the volumes, as far as we know. So on the EU side, that's a positive signal for Mercedes, BMW, for Mercedes or for European OEMs. But I do think in terms of that base tariff rate, we're unlikely to see anything below 15% for the EU. And I think that's probably not the news that Brussels wanted to wake up to this morning.
What do you think the European Union is going to do, waking up to this news, as you say? This is not exactly what maybe they want to wake up to, but do they play their hand and go till August 1st and see if they can extract something better, or do they eat 15%?
Well, European negotiators are in town this week, so we could see an announcement as soon as this week in terms of that EU deal, which we had all speculated was much closer than the Japan deal. But that said, this is a real crisis within the union itself. They had begrudgingly accepted a 10% tariff as something they'd have to swallow, and now they're staring down the barrel of a 15% tariff, and are they willing to go there? My money is they do. I think that's where the landing zone is with the European Union, but it's not news that they're going to like.
So you think potentially the European Union, we could get something before August 1st? Who after that?
So we've got a number of countries on deck. We've been talking about for several months. I think Switzerland is very close to a deal. A couple of Latin American countries like Chile or Argentina, I can see inking a deal. Several Southeast Asian nations, you can see where that's trending in terms of that 19 to 20-ish% tariff rate. And then the president has also said, as have some of his senior cabinet members, that we're likely to see a number of developing countries in Latin America, Caribbean, and Africa just get a 10% rate across the board. So I think we'll see a lot of that roll out over the next few days. I'm watching very closely to see what happens with Thailand, what happens with South Korea, and what happens with Taiwan, which are the other big economies we haven't heard much about.
Kellyanne, thank you so much for your time this morning and your insights. Jonathan, of course, Kellyanne Shaw, former U.S. senior trade advisor under the Trump's first administration, a good friend of the show now. What she says when it comes to the European Union doesn't look like they're going to get below 15% because Trump really set the bar with this deal with Japan.
That bar is a little bit higher. AMH, thank you. Thank you very much. Kellyanne Shaw was right. Take a few days off. Grab a beer. Just wait. We'll get some deals. We got one overnight.
Can we take one just for the rest of, August? Look, we got one overnight in terms of what's going to happen with Japan. And I thought it was interesting that she said that in some ways the White House gave concessions when it came to 15% across the board tariffs for Japanese vehicles and not a quota. I mean, it just shows how high the bar has been set. And then anything that goes below it suddenly seems like some sort of deal that's getting priced as such in markets.
Get comfortable, grab a drink, stick with Bloomberg Surveillance. Your morning looks like this. Coming up later, about 35 minutes from now, we'll catch up with the Treasury Secretary, Scott Bessent, plus the Commerce Secretary, Howard Lutnick, and Senator Bill Hagerty, the former ambassador to Japan under President Donald Trump. Look out for that conversation later on this morning. Coming up in the next 10 minutes or so, we'll catch up with Jill Ford of Wells Fargo on the outlook for IPOs, plus Danny Berger with your morning movers as Texas Instruments falls on tariff fears. That stock is down by close to 12% from New York City. You're watching Bloomberg TV. Outperformance for the small caps this morning. The Russell up by more than 1 full percentage point. Elsewhere, on a benchmark stateside, an all-time high in yesterday's session. Just squeezing out a day of gains this morning. We had some weight to the rally, up by 0.4%. We can talk more about this trade agreement between the US and Japan, but check out the bond market. 2-year, 10-year, 30-year. Bond yield stateside falling for 5 consecutive sessions coming into Wednesday. Rising this morning, up by 2 basis points to 436.78 in the States. In Japan, bond yields up even more. This is not about the trade agreement. This is about the future of the Prime Minister and a pretty sloppy 40-year bond auction.
It has to do with the weakest demand for a 40-year bond sale going back to 2011 in this nation, and you've got yields at the highest levels in the 10 years since 2008. The why? Because this is a country, after years of being beset by disinflation, now sees inflation, a fiscal overhang that's significant, and a lack of political will to actually increase taxes. In fact, they are going to cut taxes, and now there's a rumor the Prime Minister is going to step down. You put all this together, and you get a bond market that seems to be having some yippies.
Bonds down, yields up. They play golf in Japan.
Yeah, it's
quite
yips.
well. They have the
Yippies
yips.
isn't a thing.
Whatever.
Yeah,
I knew what you meant.
Yippies.
That's all that matters.
Woo!
That is the centre of gravity right now in the global bond market. Japan certainly in the driving seat with regards to where yields go worldwide. That's fixed income. 3 hours away from the cash open. Let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. We're getting into the thick of it with earnings season. Texas Instruments reporting yesterday, and this is a story we might need to start getting used to. That is a company that beats on the current quarter, but their forecast marred by tariff uncertainty. That's what happened with Texas Instruments. That's leading shares down by 11.2% this morning. The CFO saying, was there any pull forward effect? Is that why results were good? He said, I don't know. We have 100,000 customers. We can't tell. That's Texas Instruments. We also heard from Hilton earlier in the hour. They did raise their guidance when it came to the full year, but it was the third quarter that they actually lowered guidance. And that seems to be what this market is really hanging on to. Shares are down 2.5%. The management over there flagging a bunch of risks, and it's ones that will be familiar. It is, first of all, calendar effects for them, but things like lower government spending, less travelers coming from international places, economic uncertainty. It's stories that still haven't gone away for Hilton. So those shares moving lower this morning. Finally, ending it with, the meme stocks. It seems like we're going to get another day of this. This time, it is GoPro and Krispy Kreme, the really big gainers so far in the pre-market. Similar story to other ones. That is really high short interest, options exploding. By the way, I checked Wall Street Bets right before I came on. The top post right now is someone who's bet their entire life savings on a stock called Rocket, saying, YOLO, it's 2021 again.
Danny, thank you. Meme stock revival. That's a trade for the brave. Anyway, on a radar this morning, a top story. President Donald Trump reaching a trade deal with Japan, setting a 15% tariff rate on imports, including autos. As part of the deal, Japan will invest $550 billion into the U.S.
And there's a lot of questions around what that actually means, whether that's going to be an actual straight-up investment, whether it's going to be a loan. Okay, a lot of details still. At the same point, the market reaction tells you something. The fact that there is such a huge rally on the heels of a 15% blanket tariff shows how much the bar has been moved. And suddenly this becomes the contours of what a new deal looks like. 15% is the new 10%.
Yeah.
And then all of a sudden you have this real question around what this means for the European Union and other countries that haven't come to an agreement just yet.
I think investors are hoping that Europe just sort of goes away with 15, accepts it, and we move on. And then we kick the can with China. And we keep kicking the can with China, maybe for the rest of this second term for President Donald Trump.
There's a little bit of fly in the ointment, and that happens to be all of the other agreements that Japan came to, including boosting rice purchases by 75%, the LNG agreement in Alaska, this investment fund. I mean, there are other sweeteners around this, so it's not quite as simple as 15%. Let's call it a day. How that plays in the European Union is going to be interesting.
This is being taken as equity positive overwhelmingly. No need to push back against that. An underappreciated aspect of all of this still, I think, is just how much money this is going to bring into Treasury. We'll catch up with Scott Bessent, the Treasury Secretary, later this morning. I'd love to get an idea from him how much he expects to bring in over the next 12, 24 months. For all the talk about fiscal prudence in Washington, how much will this trade story contribute to all of that?
And how much is 10% becoming 15% in order to plug a $3.5 trillion hole? And they have these numbers and they're saying, OK, well, we can offset this deficit. But that's the reason why you're probably not going to get any subsequent administration taking these tariffs off, because that is the secret with tariffs. They do generate revenue, and it becomes incredibly politically unpopular to remove said tariffs afterwards, which is the reason why they tend tend to stick, and that's what we've seen over the past 100 years.
Especially if they start raising a lot of money for people down in Washington, D.C. I want to turn to the rest of the news coming out of Japan. The Prime Minister, Shigeru Ishiba, is facing speculation that his days are numbered, but continuing to deny reports claiming he will soon announce his resignation. This is the story at the heart of the bond market right now.
Because he was considered more fiscally prudent. He was the one who was going to push back against cutting taxes in the face of a fiscal overhang that needed to be paid back, but also concerns and unrest about growth and economic prospects. His approval level in a major poll plunged to slightly above 20%. That is considered unsustainable politically to remain in office. I just wonder how much his potential removal comes because they've actually established some sort of trade deal, or because of the trade deal that's been established, that he then can say, okay, I'm going to own that, goodbye, take it from here.
I always follow the Japanese banks and their commentary on whatever happens in Japan. You need local knowledge. Jordan Rochester of Mizuho said this: the future of the PM's in doubt, obviously, but possible replacements range from fiscal prudence to the complete opposite. That's how wide the range of outcomes right now are for fiscal policy in Japan.
And what we've seen from the polls, and frankly from this latest election, is that the ones who promise a lot are the ones who tend to win. This is a global story. Nobody wants to accept the pain of paying back debt. So if you have this on a global level and you've got the populace saying, nope, we want tax cuts, we want sweeteners, we want benefits, what does that mean for the bond vigilante that's been dared into action time and time again and sits on its hands and says, you know what, it's going to be fine? Does that call them into action? And do we see something more like what we saw overnight with the 40-year auction in Japan?
It's a red flag.
Yeah, thank you.
To the vigilantes, without a doubt, particularly in Japan. Let's squeeze in Microsoft, accusing Chinese state-sponsored hackers of exploiting flaws in the SharePoint software in a hacking campaign. China responding, saying the country opposes cybercrime, but also opposes smearing others without solid evidence.
Yeah, what could that possibly mean? Look, this is the new front for international warfare, and it's the reason why tech dominance is more than just simply an economic argument. This is the new front for intelligence, for espionage, for controlling massive entities, and that's the reason why this is going to continue to be such a major, major focus. How do we get that investment on a national level for national security reasons? And that's the reason why this is, you know, the rock star, right, is Jensen Huang, because he's at the forefront of that for the United States.
Earnings from Microsoft due in the next week or so. Let's turn back to markets. We're seeing a resurgence of IPOs this summer. Jill Ford, co-head of equity capital markets for Wells Fargo, expects activity to pick up in the second half of 2025. Jill joins us now for more. Jill, good morning.
Good morning.
Markets wide open. Is it healthy? Is the kind of activity that you're across right now what you would describe as healthy?
Well, I would say, IPO volumes have certainly been lackluster for the first 6 months of this year, particularly contrasted versus all the expectations post the election late last year. We are starting to see signs of life within the equity capital markets, and particularly with IPOs. They are pricing well, they're trading well, buyers are making money, they're looking outwards now as we get more clarity with these tariff deals. They're looking for new ideas as opposed to hunkering down and trading what they know. And that's really, really healthy for the IPO market. So I'm optimistic. There are lots of IPOs coming. Many IPOs came in June. There are many more coming in July. And the fall is looking pretty good as well.
The typical lifespan of a company has obviously shifted. They're staying private for a whole lot longer. Can you describe to us as to why they're not going public? Are they push factors or pull factors? Are you just seeing people sucked into private markets and staying there because the options available to them are so good?
A lot of it is driven by the companies that own them, the private equity sponsors. They are very unemotional about when they sell things. They want to sell at full value. They want to realize the full value that they deserve for their assets. And when IPO markets have larger than normal IPO discounts, they're going to sit back and say, what are my other options? And there's lots of options for treading water. I can give you a whole list of ways that private equity firms have decided to keep their companies private longer. The flip side is when they do come out, they're more mature. They have acted almost like a private company for longer. The management teams have become accustomed to managing expenses, not growth for growth's sake. So you're getting a higher quality company that is coming out.
It also indicates that they see the market as frothy enough to handle some of the potential valuations that they would like to see for those exits that they might not be getting in previous markets. The market's been open a long time. It's just not at the price that they want. And I wonder if it tells you something about where we are in markets, that a lot of companies are starting to say, OK, if we're not going to pull the trigger now, I'm not sure when we can.
Two things are at play here. The first one is the IPO market as a cohort for 2025 is up close to 50%. Now, there's a couple of high flyers in there that are driving it higher, but versus the average 15% pop, That's really meaningful for people's portfolios. The second thing that's going on is that people are starting to realize the queue is getting so large, we couldn't cycle through it in a single year. The IPO backlog right now is about 200 companies or so that have filed confidentially. There's probably another 200 to 300 companies beyond that who are IPO worthy who have not yet gone through that process. So if you take an average IPO year of, call it 75 to 100 IPOs, you're looking at several years to try to clear this queue. Do you want to be in the front of the queue or do you want to be in the back of the queue?
We keep hearing this, the idea of the backlog building and the idea that the pipeline is full. It's just a matter of when you're going to pull the trigger. And I wonder if the tariff levels that we've gotten overnight are enough certainty, especially when paired with the legislative certainty that we've seen in Washington, D.C., for a lot more companies to pull the trigger.
Well, I do think that IPOs love boring, right? They don't want volatility. They're out for 7 to 8 days of market exposure. And the great news is that for the last few months, we've started to see the market shrug off a lot of that news flow, right? And so with continued clarity on tariffs, A, we've got a calmer market, hopefully, but B, CEOs and CFOs are going to be able to forecast their business more accurately. If you can't forecast your business because of tariffs here, there, and everywhere in your supply chain, you're really going to struggle to give people comfort to come into a new name. So those two things are at play, and we're starting, hopefully, to be on the road to more clarity around that.
Jill, could we finish on the resilience of corporate America? This has been an ongoing theme now for the last several months. You talked about them being battle-hardened, battle-tested once they became public companies. Can you reflect on your experience of just how resilient corporate America actually is? The ability to borrow a phrase from our good friend TK, to adapt and to adjust?
No question. 2021, we obviously saw a lot of nonsense go on and a bit of a bubble and then very, very little activity in the years following. I think companies have had to learn to be much more prudent, conservative, to manage not just growth, but to manage margins. If they're not profitable, to have a bridge towards near-term profitability. And overall, that's created a really healthy backdrop. The other thing to focus in on is the health of the consumer, right? If your consumer's not healthy, it's now the right time to be going public. As the consumer also appears to be very resilient, we're seeing those corporations that have them as customers become even more resilient and healthy. And so we're optimistic through the second half of 2025 and certainly well into 2026 as it relates to IPO volumes.
Jill, this was great. It's good to catch up. Thanks for the update. Jill Ford there of Wells Fargo. You've all heard the phrase before, never bet against the US consumer. Bank of America's Savita Subramaniam said something similar to Jill. Never underestimate corporate America.
And we've seen that time and again. And that's really something that we saw coming out of the pandemic. But right now, the ability for these companies to maneuver and tweak around the edges to just get that perfect mix where consumers can adjust to a little bit higher prices, but also absorbing just a little bit on their bottom line has really been rather surprising.
Record highs on the S&P 500 coming into Wednesday this morning. Futures up by 0.4% with an update on stories worldwide. With your Bloomberg brief, let's cross over to Yahira. Hey, Yahira.
Hi, John. The UK Supreme Court has just reversed the convictions of Tom Hayes and Carlo Palumbo, the traders who were found guilty in the LIBOR scandal. The court allowed both appeals, stating that the juries had been misdirected at both criminal trials. Hayes was sent to jail a decade ago, while Palumbo was jailed back in 2019. Meanwhile, Roche paused some shipments of the controversial gene therapy Elevidys following a similar action by Sarepta Therapeutics. This coming after 2 teenage boys died of acute liver failure after taking the drug. Roche described the pause as voluntary and temporary. And Danny mentioned this one earlier, but take a look at Texas Instruments. Shares are plunging in the pre-market. The chip maker beat most estimates, but failed to offer investors real insight into the impact of tariffs on margins. Executives from the company simply acknowledging they don't know how much of their 16% revenue jump came in from tariff-related pull-in. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in about 30 minutes. Up next, the pressure building on Tesla and Elon Musk. We'll catch up with Ben Kallo of Baird. That's stock positive by just 1/3%. From New York City, this is Bloomberg. trade deal between the United States and Japan unleashing a rally worldwide in Japan and stateside. Look out for this. In about 13 minutes from now, a conversation at 7 a.m. Eastern Time with the Treasury Secretary, Scott Bessent. Then later on this morning, the Commerce Secretary. And then after that, some insight on Japan with the former ambassador to Japan, Senator Bill Hagerty. Fantastic lineup coming up right here on Bloomberg Surveillance. Under surveillance this morning, pressure building on Tesla and Elon Musk.
Investors have hit a point where they want him focused on Tesla and AI. This is a key few years ahead for Tesla, going not just from Austin, but 25 cities over the next year. We've said the biggest asset when it comes to autonomous is Tesla, because when you think of Waymos, they're not going to scale at any level relative to Tesla. So when you're competing with China, Tesla and Musk is an asset, no different than Jensen.
It's the latest this morning. Following a 2Q policy storm for Elon Musk, investors looking ahead to Tesla earnings out after the closing bell. Joining us now to discuss is Bloomberg's Craig Trudell. Craig, welcome back to the program. Let's just talk about the underlying business, sales. How are they holding up?
Not well, in short. I mean, I think we got, fresh indication of this, maybe just sort of further drilled down just yesterday, a look at California registrations for Tesla. They're now down in that state 7 consecutive quarters and down substantially in the second quarter. I think maybe the most alarming figure you saw in there was a real weakness for the Model Y. This was, of course, the one of the sort of excuses, if you were Elon Musk, for the early year sales weakness at Tesla was, oh, this is, just has to do with the fact that we have, this new model that's coming out. We needed to take some plant downtime and we needed to have this, changeover. But this new vehicle is sort of waiting in the wings. It does not seem, at least thus far, like that is delivering the sort of relief that Musk and Tesla were hoping it would.
Craig, it would be hard enough to just run a car business right now. But the individual leading the car business has had all this tension down in Washington, D.C. as well. What is holding back the stock? One or the other or both?
I think there's real concern on a day-to-day basis on, sort of just what Musk is up to, right? Is he dedicating the time to Tesla that he told shareholders he would a quarter ago when he last had an earnings call? And, this is a CEO unlike most others in that he sort of lives his life very much online, where we have a real sort of clear sense of, today, is he working at XAI? Is he, playing video games? Is he doing, anything but working for his car company that is his most valuable, company in his empire, and one that, has felt a bit neglected the last, year plus in terms of, the sort of reinforcement of product that everybody was hoping we would see. In particular, more affordable models that would enable Tesla to grow again.
Craig Trudell out of London this morning. Craig, thank you, sir. Let's get the view from the analyst community this morning. Ben Kallo of Baird has a neutral rating on shares of Tesla, a 320 price target. He joins us now for more. Ben, welcome to the program. You've been cautious. You've articulated that view to us quite a few times over the past few months. Why are you cautious into this report later on this afternoon?
Well, I think, as your previous guest talked about, the sales slump, we will see a pickup in Q3. There is an end to the $7,500 tax credit for U.S. consumers. So there will be a little bit of a pull-in of demand there. And so we should expect, stronger Q3 delivery numbers. But we're still seeing discounting heavily in China. We've seen poor numbers out of Canada, albeit that's a small market for them, and then Europe too. And I still think that there is somewhat of a Musk factor there with brand destruction. Destruction is a tough word, but maybe brand tarnishing for him there. Now, I think investors are looking through a lot of this to robo-taxi. The clip you played in the beginning talking about Waymo not being able to scale. They scale differently. They have different technology. It takes more money than Tesla. But I think that they'll be a fierce competitor to the robo-taxi that Tesla delivers, even if Tesla can scale more quickly.
Ben, just to build on that one point about Elon Musk and some of his political involvements, yesterday SpaceX put out a tender offer in which they listed for the first time a potential risk factor that Elon Musk, the founder, might potentially get back into politics. What do you think happens if Tesla has a similar type of warning in its documents today, and do you expect that?
I would expect it to, when they do, if they list it as a risk in the filing, the quarterly filing. I think that it's well known out there. The degree that he gets into politics and kind of the statements that he makes, I think is another risk factor for the stock, and definitely for the brand. And just one thing that we've highlighted or tried to highlight, in addition to the car being a brand, robotaxi is a brand too, especially when you start thinking about in the future getting into a vehicle without a driver there, and it's a Tesla vehicle. If there's a backlash against Tesla like we've saw before, which seems to have quieted down a bit, but still that I think would deter people from riding in their vehicles, just like it has in the past for people buying their vehicles.
Brand reputation and just sort of the myth around Tesla has been so important since people have said this is a stock built on hopes and dreams and the expectation of what the robotaxi universe looks like. Is that enough still, given the fact that the deliveries numbers are going to probably not look great, and the fact that the robotaxi effort's been moving slower than we've thought, and you've had the potential lack of a political clean slate to really get this over the finish line in short order?
No, we've covered the stock for over 10 years, and a lot of the promises have been met, albeit a year, 2 year, 3 year late. I think that what's interesting to me is that after last quarter and really one of the worst quarters that I'd seen out there, that the stock still reacted favorably because of some of the promises with Optimus, with the robotaxi rollout. So it still has, Elon still has that ability to inspire and to keep the valuation and keep people dreaming the dream. I don't know how long that lasts. We've heard reports out that Optimus is going to be pushed out. I do think that between Optimus and robotaxi, Optimus is an area that we're much more bullish on. It's going to be competitive, but robotaxi is going to be very competitive too. As more companies bring vehicles to the road.
Hey, Ben, appreciate the update from you, as always, sir. Ben Kallo there of Baird, looking ahead to numbers from Tesla after the closing bell alongside Alphabet. The focus this morning is on trade. We have a deal between the United States and Japan. A question this morning, can we strike a similar deal with the EU? And what happens if we don't? This is the latest breaking news from the team over in Europe, from Bloomberg. The EU plans to quickly hit the US with 30% tariffs on some 100 billion euros worth of goods in the event of a no-deal scenario.
Yeah, and some of these include Boeing aircrafts as well as cars made in the U.S., as well as bourbon. I mean, you start looking at the locations where some of this is made. This, to me, is also interesting. Berlin would also potentially be willing to support the anti-coercion measures that they had been talking about before, including potentially taxing some of the tech companies from the United States. That necessarily isn't part of this, but still open to that. Just raising the ante ahead of this deal. Is it really going to be as clean as 15%? Let's call it a deal. Goodbye, go home.
This is part of an ongoing negotiation, quite clearly, from the EU side to get that information out there without irking the US side too much. This is where we've been at now for the last several months.
Yeah, is this the EU saying to President Trump, here's your letter. This is our potential
negotiating
response.
In the press.
Exactly. And so we're the ones that are evidently the conduits for it.
Up next on the programme, the second hour of Bloomberg Surveillance just around the corner. Don't miss this, a must-watch conversation. The Treasury Secretary of the United States, Scott Bessent, up next.
This is not necessarily an all-clear environment.
It is kind of a murky data picture.
I'm not sure we can actually pinpoint what the Fed is going to do. There are costs. There are costs in the economy to the Fed having interest rates as high as they are.
We do think they should be cutting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We've got some more good news. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 positive by 0.4%. On the NASDAQ 100 up by about 0.1%. Some outperformance on the Russell. The small caps up by 0.9. Later on this afternoon, look out for this. Earnings from big tech. The Mag 7 start to report earnings. We'll hear from Alphabet. We'll hear from Tesla. And then coming up tomorrow, apparently we're going to look ahead to an ECB rate decision and jobless claims too. Why I'd look ahead to that right now? I've got no idea, because we're focused on Japan and the United States striking a trade agreement.
Yeah, evidently uncertainty is worse for equity markets than the prospect of tariffs at 15%, which are higher than that 10% level that so many people had expected to see. And that's the reason why you're seeing auto manufacturers in Japan flying. It isn't necessarily hampered, that industry, by extra tariffs or quotas, et cetera. And 15% evidently we can digest. Now come the earnings. Do we get that same sense of clarity from corporate executives that have to adapt and adjust to all of these new realities, even if you have that certainty coming from the administration?
These are trade agreements right now, very much in focus. We've struck a deal with Japan. That's good news. Can we apply the same template to the Europeans? Can we apply the same template to some of these other major trading nations and then move on?
Based on the reporting from Bloomberg over the past couple of minutes, I don't know. It's going to be a real question if you have the kind of retaliatory talk coming from the European Union of a potential 100 billion euro package of retaliation on a whole host of different goods. Is that really going to endear themselves to the president to get something over the finish line? How much has the bar shifted? Where 15% would be fine, just as we said a week ago, 10% would have been fine, right? Has that moved enough where 15 is a new 10, and that's okay?
We've had some exemptions, we've had some extensions. Have we actually had the tariff test yet? And looking at the likes of Texas Instruments, the nervousness on their conference call going into the second half didn't exactly instill confidence in investors in the stock this morning.
The fact that shares are lower by more than 11% in pre-market trading after the company reported better than expected earnings, but then said, we don't know. Honestly, we have no idea how many of our 100,000 customers brought forward their demand because they were uncertain about tariffs. Well, that's just honest, right? How many other companies can be that transparent with some sense of security about what to expect in the road ahead? These are some of the questions that we have. Corporate executives might have certainty about a rate, but how it works itself through the economy is going to be a really more complicated measure, and how they really game that out with profitability is going to be a real issue.
That's the stock market. Let's briefly talk about the bond market. Stateside, yields just a little bit higher, not by much, but over in Japan by a lot. The deal in Japan is one thing. The future of the Prime Minister is quite another, and it's the future of the Prime Minister and the trajectory for fiscal policy that is shaping not just this bond market in Japan, but arguably this bond market worldwide.
Has the bill come to roost in the sense that so many different developed market economies have propped up their economic well-being by borrowing money, and the developed world has been able to do that without necessarily the kind of punitive actions by bondholders that the developing world has seen? So is that starting to shift, where suddenly the fact that nobody wants to pay for this is becoming a problem for the bond markets? Yes, in Japan, we're seeing that to a big degree, but do we start to see that more globally as well?
Bonds down in Japan, yields higher. Coming up on the program this morning, a fantastic lineup for you. Moments from now, the Treasury Secretary, Scott Bessent. Next hour, the Commerce Secretary, Howard Lutnick. And later, the former ambassador to Japan, Senator Bill Hagerty. We begin this hour in Washington. President Trump announcing a trade deal with Japan.
I just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. We worked on it long and hard, and it's a great deal for everybody. I always say it has to be great for everybody. It's a great deal. A lot different from the deals in the past, I can tell you that.
Joining us now from Washington, D.C. is Annmarie with a special guest. Hey, Annmarie.
Hey, Jonathan. Good morning. That's right. I'm joined by the U.S. Treasury Secretary Scott Bessent this morning on the heels of this agreement the president announced last night. Last week, you joined me, John, and Lisa, and you said you were going to Japan for the World Expo. It wasn't really going to be focused on trade. You came back. The president had a 75-minute meeting as well last night with the trade negotiator. You were in the room, and he got this deal with you alongside him over the finish line, even though the reporting out of Washington that actually the discussions with Japan were quite difficult. What changed in the last 24 hours?
Look, Annmarie, we had some discussions about the overall U.S.-Japan relationship, which was one of the strongest in the world when I was in Tokyo and Osaka. And then we got back. There were elections on Sunday. LDP did slightly better than expected. They don't have a majority. Japanese government was ready to deal. And as only President Trump could do, he brought the Japanese trade delegation into the Oval and had a very fulsome negotiation with them. And I tell you, they're tough negotiators, but President Trump's tougher.
Well, there is a photo circulating on Twitter from Dan Scavino, and you actually see a Sharpie X out of some what looks like preliminary deals for even more concessions with Japan. I want to ask you about this 15% tariff rate. Is that the new floor now for trading partners when you're going into these negotiations?
Well, I think it's very important to know that 15% for Japan for reciprocal tariffs for autos, that is a different kind of deal, but because the Japanese proposed a very innovative solution. We've been working with them for months, the trade team, myself, Ambassador Greer, Secretary Lutnick, and they came to us with the idea of a Japan-U.S. partnership where they are going to provide equity, credit guarantees, and funding for major projects in the U.S. So they got the 15% rate because they were willing to provide this innovative financing mechanism.
There is a lot of Japanese FDI into the United States already. Is this new capital?
Oh, no, this is all new capital. This is all new capital, and it is going to be targeted at the strategic industries that President Trump and this administration believe that we have to de-risk on. During COVID, we saw our vulnerabilities, whether it was in medicines, semiconductors. So we are going all in over the next few years to de-risk our supply chains, and this deal, thanks to President Trump, is going to be part of that.
When it comes to the 15% rate on autos, this means that Toyota is basically paying a cheaper rate than, say, GM if they have inputs from other countries. They're still at the 25% auto rate. Do you see the auto rate leveling out to something lower than 25%?
We'll have to see. And again, those are just GM components. There's also the USMCA, the portion of any autos assembled in the U.S. And then, of course, GM and especially Ford. I think Ford has the largest U.S. production. You build it in the U.S., there are no tariffs.
So when it comes to what's next, we know the EU negotiators are in town. This 15% rate feels like potentially a floor. Could anyone get below 15%? Is the European Union still trying for a 10% minimum baseline tariff?
Well, again, the 15% is a result of this very innovative package that the Japanese came with, and President Trump being able to push them to do even more. So,
has Brussels come up with anything innovative?
Not yet, but again, talks are going better than they had been. I think that we are making good progress with the EU, but as I've said before, Annmarie, the EU has a collective action problem, 27 countries. Great thing about dealing with the Japanese, I've been going to Japan since 1990. I think this weekend was my 52nd trip. And the Japanese government moves as one entity. They're highly organized across all level of government.
So you say the talks are going better. We just have a story hitting the terminal this morning from our colleagues in Europe that the European Union is readying $100 billion euros if there is no deal in place. They will impose 30% tariffs on those 100 billion euros worth of goods. Do you think we're going to get to that place?
I think it's a negotiating tactic, and it's what I would do if I were in their place. But Annmarie, remember, we are the deficit nation. They're the surplus nation. So any kind of a escalation in trade problems will always hit them worse.
I want to also talk to you about what's going on with China. You're going to Stockholm Monday, Tuesday to meet with your Chinese counterparts. Are we going to continuously see the discussions revolve around rare earths and export controls, or are there going to be other items on the table?
I think we're in a very good place with China now, and we can start moving on to bigger discussions. As I've said many times, there is the potential for a big, beautiful rebalancing between the U.S. and China. President Trump is committed to bringing back precision manufacturing to the U.S., and as we become more of a manufacturing economy, China is highly imbalanced. They account for 30% of all the manufacturing output in the world. That's not sustainable. we believe they should become more of a consumption economy. If they are willing to go down that route, then we could actually do it together. And then there are lots of other things we can talk about, whether it's them buying sanctioned Russian or Iranian oil, a number of security things. And so
What about the purchasing agreement from Trump's first administration? He had a deal with China, the Phase 1 purchasing agreement on agriculture.
Well, again, that's another way that we could bring this imbalanced relationship into balance. So we will be talking about purchasing agreements, especially ag. So, and to refresh everyone's memory, we had the purchase agreements. Chinese lived up to the purchase agreements during President Trump's final year in office, and then the Biden administration didn't enforce those purchase agreements. So, we're going to let bygones be bygones. We're going to look forward, and I think we can come up with some very interesting purchasing agreements. As you know, President Trump is committed to the American farmers.
Well, looking forward, you told me, John and Lisa, last week, the market doesn't need to worry about August 12th. That's the deadline for this current détente between Washington and Beijing. What's the new deadline going to be?
Well, again, I think that we could roll it forward, maybe in a 90-day increment. And I think the good news here is that we are back on track with the Chinese negotiations. On April 2nd, President Trump told countries, here's your reciprocal rate, but that was the ceiling. If you do not escalate, if you don't escalate, this is the max. The Chinese chose to escalate, but now both sides have de-escalated, and I think we can get into a very good cadence of regular meetings with them. And look, we're the two largest economies in the world. We do not want to decouple with the Chinese. We just need to de-risk part of our supply chain.
Does regular incremental meetings include a meeting between President Trump and Xi Jinping this fall?
I do know that Party Chair Xi has invited President Trump to visit China. I don't know. I don't have dates on that. I don't know if the president's accepted. I know they have a fantastic relationship on a personal level, which I think forms the basis of everything between the U.S. and China.
Local reports in China were talking about the two meeting on the sidelines of the APEC summit in South Korea this fall. It's end of October, early November, or maybe President Trump going to China first. Could we see a meeting that soon? You think a meeting within this year can happen?
Again, I'm not privy to the president's travel schedule beyond September, so we'll see.
And nothing before a meeting with Xi Jinping before September?
Nothing before Labor Day.
So in the last week, I do want to go through something that's going on with China. They've imposed exit bans on a Wells Fargo banker, a Commerce Department employee, and according to Microsoft, they hacked into their software. Will you address these actions at the talks in Stockholm?
We're going to address a whole host of things, and obviously things like that will be on the agenda with my Chinese counterpart.
You had said to me last week that the NVIDIA H20 chip was potentially a chip in negotiations, a mosaic, part of the deal. Do you think China's doing this for leverage at the trade table?
Absolutely not. Absolutely not. Because, again, the H20, while it is an advanced chip, is not one of the most advanced chips. I think if we were to think about the NVIDIA stack, the HP would be something fourth, fifth down the stack. And my understanding is that Huawei can produce something with similar efficacy.
But China's malicious behavior, even just in the past week, even targeting a Commerce Department employee, do you think they're doing this to have leverage with the United States?
Well, I can tell you in Stockholm, it's not going to give them any leverage with me. And it's a big, sprawling bureaucracy. And sometimes I think we may see the arrest may have been in a province. The central government may not be aware of it. So, I would highly doubt that something at that level that they have wanted to engage with the U.S. We are engaging with them. And I think both sides want to move forward in a productive way.
But you'll raise these issues?
Yes.
So now that the administration is getting trade deals across the finish line. Japan, Indonesia, Philippines. Yesterday, you said the European Union potentially in sight. Do you think the Federal Reserve is going to have enough clarity by September to cut interest rates?
Again, I'm not really sure what the Federal Reserve is looking at because thus far we have not seen, or we've seen very little, if any, price pressures from the tariffs. And if we were to see those, they wouldn't be inflationary, it'd be a one-time price adjustment. So I think that their analysis of tariffs is a bit off.
Well, Governor Waller made this exact case to us on surveillance on Friday, and it sounds like he might dissent at this meeting. He also said the president hasn't called him yet. He's one of these names that are circulating around. Could he replace Fed Chair Jay Powell? Is he a name you're looking at? Have you reached out to him?
I think there are a lot of strong candidates, including several who are on the main board and perhaps regional bank presidents.
So are there other names outside of Kevin Hassett, Kevin Warsh, Christopher Waller, and you yourself has been circulating?
There's a long list. And like I said, there's some great candidates.
And have you reached out to everyone on both those lists?
I'm not going to talk about the process, but we are getting the process underway. Obviously, it's going to be President Trump's decision, and we're not in a rush.
So, you're not in a rush, but the president continuously says he wants to get rid of the Fed Chair Jay Powell. Mohamed El-Erian yesterday said he should resign.
Well,
do you think Jay Powell should step down to protect the institution?
The couple of things. One, the president said he is not going to fire Chair Powell. I was somewhat surprised that Mohamed El-Erian came out and said that. And what I've come out and said is that I believe that it would do Chair Powell a favor and he would be doing the institution a favor if he did an internal review, separate monetary policy from everything else. And this is something that Larry Summers and I agree on, is this mission creep from the Fed is endangering their independence of monetary policy. So all these other things that they're engaging in could threaten monetary policy. So it is a big, sprawling institution. The central budget for the board is up 4x since 2004. And, every institution needs to examine themselves.
But you want the man that you guys don't think is doing a good job to run that review?
What's that?
But you want the man, Jay Powell, which you and the president don't think is doing a very good job, to run the review of the institution?
Well, I think that it could be a committee. It could be a group. They could invite outside experts in. The Bank of England, after the 2022 rate hike shock, went back and did a very good examination of what went wrong with monetary policy that brought in outside experts. So, I think an internal review would be a good start. And if the internal review didn't look like it was serious, then maybe they could be an external review.
Have you communicated this directly with Jay Powell? Do you guys continuously have your once a week breakfast, lunches, either at the Fed or the Treasury?
I gave a speech on Monday night on bank deregulation, bank regulation, the future of regulation, which is, aside from monetary policy, I think the most important thing for the economy. The Fed is one of three regulators. There's the Fed, the Office of Controller of the Currency, which sits under Treasury, and the FDIC. And I believe that all three of those should have important voices, and I believe that the regulation has been much too stringent since the great financial crisis. We are seeing this big buildup outside the regulated financial system. I think I saw something 2 days ago, the private credit is up 10x. I'm not saying it's a financial stability problem, but I am saying that there's a regulatory arbitrage going on. But that was a long way of saying I saw Chair Powell at that speech.
And your lunches and breakfasts continue?
Always.
So you have a good relationship with him at the moment?
We have continuing communication.
Last time you were on, you also talked about the potential next Fed chair. You said his or her nomination.
Is Governor Bowman also in the running?
Again, I'm not going to name names, but they're good candidates. As I said, on the board, there's several female regional bank presidents, and then there are some fantastic women outside the Fed.
There's also Governor Kugler's chair that is open in January. Have you started that process?
It's a simultaneous process. The Kugler chair is a 14-year seat, so we'll be looking at that also. And again, I think we have some very good candidates.
Given you just saw Jay Powell, has he yet to tell you whether or not he is going to leave the board, his governor seat, before 2028?
He hasn't yet. My belief is that he will, and I think that it would be very good for the institution for him to do it, and I think it'd be very good for him personally to do it.
The president once said that he goes out and riles financial markets, and then he sends you, his Treasury secretary, out to calm things. Things are pretty calm today. But when it comes to the Fed chair, I know you love college basketball, and you talk about the president being Bobby Knight, and I know you love Dean Smith. Are you guys playing this good cop, bad cop when it comes to talking about the Fed, talking about Jay Powell?
Not at all. You know, Annmarie, the reason I think that I'm, to the extent I'm able to calm the markets, and you know, that doesn't always happen. I was in the investment business for 35, 40 years, but I think more importantly than that, I understand what President Trump is doing. And a lot of times he's 1, 2, 3 steps ahead of the market. And, you know, as you know better than anyone, the market wants instant explanations. They want clarity. They want immediate gratification. So I think that I'm able to, as a former practitioner, I think about when President Trump tells me what his goals are, I think about what is the best way for me to give good framing to market participants, for them to understand what he's doing, because you know, he always has a plan. It's not always obvious.
So you are communicating almost the strategic ambiguity that he likes to operate from.
Well, and I'm also trying to explain that there is a plan, because you know, look, you know, these letters went out. Everyone was, oh my gosh, these are high rates. And I think the president created maximum negotiating leverage, and the market actually took it pretty well, took it pretty well.
Just to finish on that final point then, do you think he's more emboldened to go for higher rates with trading partners now, given the market is not pushing back?
Well, I think he's created a lot of leverage because he's created an A-B situation. He is able to go to the trading partners and say, look, I am happy to take in this tariff income if you don't want to negotiate. This is a high rate, but you know, the U.S. is taking in massive amounts of tariff income. We had the first June budget surplus since 2015 last month. We reported it this month. And so we are taking in substantial income. So President Trump is creating this leverage by saying, if you don't want to negotiate with me, I've sent you a letter with a high rate. Have at the high rate, or come and negotiate in better fashion. Because I'll tell you, what was fascinating for me, and this was President Trump at his best, was the Indonesians came with what I thought was a very good offer out of the blocks. President Trump kept pushing them. He raised the reciprocal rate when he sent them the letter, and 5 iterations later, the Indonesian trade deal was greatly improved, turned into a great deal for both sides.
Secretary Scott Bessent, thank you so much for your time this morning. John, Lisa, of course, the U.S. Treasury Secretary Scott Bessent this morning on the heels of that deal with Japan.
Annmarie, great work, as always. Annmarie there on that agreement with Japan. To unpack the other things in this, I think 2 main features here. One on a deal with the Europeans, a potential agreement down the road, and the other on the Federal Reserve. On the Europeans, talks with the EU are going better than they had been, just turning down the temperature just a little bit, saying that the EU's retaliatory preparation is a negotiating tactic. I would do the same if I were in their place. That's the European Union. Then on the Fed, the president has said he's not going to fire Chairman Powell. Disagrees with them on the analysis, but we're not in a rush to nominate a new Fed chair. And he threw in regional Fed presidents as well, which I thought was a new bit of information there too.
Given the fact that we've had a pretty limited slate, this sort of opens the door not just to Mickey Bowman, who's a governor, but also to some others who potentially have come out with more dovish tints. So everyone could be running. I mean, that's sort of my takeaway, the idea that they're really broadening it out.
Maybe that list is longer than we thought.
Exactly.
Longer than just the two Kevins,
yeah.
For instance. Up next on the programme, James Picariello of BNP Paribas as the US and Japan agree to a 15% tariff on Japanese autos. Record highs coming into Wednesday. Equity futures this morning positive by 1/3%. At the epicenter of this conversation, a trade agreement with the US and Japan. More on that in just a moment. On the S&P up 1/3, on the Nasdaq up 1/10. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. We got AT&T earnings about an hour ago, and across the board, the metrics were good. They beat. They also outlined, much like Verizon, that they're going to save a whole lot of money from the one big beautiful bill. For them, it's $6.5 to $8 billion worth of savings that they're going to reinvest into their network. Even so, check out what shares are doing. They're down 3.5% in the pre-market trade. Maybe after Verizon's really stellar set of earnings, this was a market that was expecting maybe perfection and then some, maybe a rise in guidance, which we didn't quite get from AT&T. Meanwhile, the energy players, they are rallying. The energy providers like Constellation Energy and Vistra. That's because there was an auction yesterday for power supply on the grid, and the prices there hit a record. It really underscores how this AI boom is creating more demand and keeping prices elevated to benefit these players. So those shares up around 5%, 5.3% for Vistra. Finally, we also had Capital One earnings after the close yesterday. Again, another solid set of reports that shows that this is a consumer that is doing fine. They lowered their loan loss provisions to lower amount than was expected. Really healthy there when it comes to credit card and debit spend. They also recently acquired Discover Financial, so they had higher costs as they integrate that, but analysts noting that the integration is going well. So shares up 2.6% in the pre-market, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, President Donald Trump announcing a trade deal with Japan. The agreement imposing 15% tariffs on imports, including autos. The Treasury Secretary, Scott Bessent, speaking with us just moments ago.
We had some discussions about the overall U.S.-Japan relationship, which was one of the strongest in the world. As only President Trump could do, he brought the Japanese trade delegation into the Oval and had a very fulsome negotiation with them. And I tell you, they're tough negotiators, but President Trump's tougher.
The conversation will continue this morning. In about 30 minutes from now, we'll catch up with the Commerce Secretary, Howard Lutnick, trying to figure out whether this is a decent template for everybody else.
First of all, I just want to say that I want to get to the place where I can say the Oval Office as the Oval with such familiarity. But I digress. I think that the most interesting thing that he said was that the Japanese came up with an innovative solution, and that is the reason why they got that 15%, which was actually a concession, particularly on the auto manufacturers, because of some of the sectoral tariffs that could otherwise have raised that to 25% or more. And this raises a question of whether it is a template for the likes of the European Union or whether it really is bespoke. And it is nation by nation or nation by region and how they negotiate and what types of solutions they come up with.
That's trade. He also had some things to say about the Federal Reserve. Secretary Bessent really likes to try and take down the temperature on a range of issues, including the Fed. Not going to fire him, not in a rush to select his replacement. So there goes that shadow Fed chair conversation just for the moment. And then the president will speak later on. And no doubt we'll double down once again on Jerome Powell, the chairman of the Federal Reserve. And it's a story that just won't die.
Yeah, it's President Trump that tries to raise the temperature, and then Scott Bessent who comes and brings the temperature down and says that we're still having lunch or breakfast or whatever every other week. We have a really good relationship. And by the way, we're not in a rush. That was really interesting to me. Also, let the guessing games begin. The regional Fed presidents, as well as lots of women outside the Fed qualified. Okay, everybody get their bingo cards out and let's put some more in other than the Kevins.
Maybe you will become familiar with the Oval. You don't know, Bramo.
I know.
Might be in the running.
No, the president has not contacted me yet, but when called to service, that's not ever going to happen.
Bramo likes high rates and lots of market discipline. High rates, lots of discipline.
Oh, come on.
Okay, let's talk about a lack of discipline. Meme stocks making a comeback. Retail traders buying into heavily shorted companies with low share prices in a move reminiscent of 2021. GoPro and Krispy Kreme, the latest targets this morning.
Maybe people just really like donuts. Look, I'm really struck by this idea of what happened with GameStop and how much it's a template for a lot of the Redditors going forward. You look at the stocks that are most shorted, that have the lowest price, and you try to win against the hedge funds. That behavior coming back. Is this the stupid money, the dumb money, or is this the smart money in terms of playing a new game and indicating a new player in a market that, yes, might be getting frothy, but might have more legs because of this FOMO type behavior?
To that point, does it speak to broader froth? So Jonathan Levin of Bloomberg Opinion put a great column out yesterday. Just selected this paragraph from him, this quote. Only 61 of the stocks on the S&P currently trade above their consensus 12-month price targets from Southside analysts. The 20 to 2024 average was around 64. And he said during the meme stock mania of 2020 and 2021, it wasn't uncommon for around 150 companies to meet that criteria. So, I mean, it's one selection, one data point to look at how bullish Southside analysts are right now. But I think it's a decent piece of data just to say there's not crazy FOMO froth taking over the whole of Wall Street just right now.
You said it really well before. Just because you find a pocket of gambling doesn't mean that the whole thing's a casino. And I thought that was a really astute comment. And it really does speak to how this might just be a pocket and a trend and a fad and some games on Reddit, but not necessarily something that speaks to a broader move.
For the broader market, we do have some broader earnings. Big tech earnings kicking off today. Tesla and Alphabet reporting results after the closing bell. The Mag 7 expected to post a combined 14% rise in second quarter profits. That's real money.
To me, this is really going to be the ultimate test. So far, we've seen the retail-facing stocks, the consumer-facing stocks. That's one thing. But when you take a look at big tech, how secular is this shift in investment, in technological advancement that can keep driving some of the market activity regardless of tariffs and broader concerns about how long some of this energy can last in the economy?
Alphabet and Tesla reporting after the closing bell. Alphabet on a 10-day run of gains, the longest winning streak, I think, going back to 2010. Unreal. Equity futures this morning positive by 1/3 of 1%. Let's turn back to the autos. Global car makers rallying after President Trump agreed to a 15% tariff on autos imported from Japan. James Picariello of BNP Paribas Exane joins us now for more. James, good morning.
Thanks for having me.
I think the good news is 15 is not 25. The bad news is still 15. What does it mean for these guys?
Yeah, I mean, look, we import, the U.S. imports about 4 million vehicles from Japan and Korea. So, let's just round numbers, say 2 million vehicles from Japan. I think we're going to talk about GM. And GM imports 400,000 vehicles from South Korea. And, that's if we were to go from a 25 to a 15% tariff rate, GM's looking at an immediate $1 billion annualized benefit in terms of tariff reduction.
Is that your top pick right now? Is that why you like GM? You think this is ultimately the direction of travel?
Yeah, there's a long list of scenarios as to how tariffs get better and a very short list as to how they get worse from here. And GM has one of the highest tariff exposures, right? They import 1.2 million vehicles in total. And the stock, I've got the full tariff impact without any relaxed, scenarios. And I would say 2026 represents trough earnings because of that tariff impact, and the stock trades at a trough multiple. Usually when the market has confidence in trough earnings, you see stocks trade toward a peak multiple. Not the case for GM.
Well, this raises the question exactly how they're going to absorb it and the potential that they could be facing higher tariff levels than even Japanese auto manufacturers on some of the parts that they import from overseas, because they'll be subjected to more of the sectoral tariffs that Japanese auto manufacturers have been exempt from. How does this not put them at something of a slight disadvantage, at least in the near term, as they try to hash out some of these other sectoral tariffs?
Yeah, so the U.S. manufacturers, right, if we think about Ford, GM, Stellantis, they import the majority of their parts from North America, Canada, and Mexico. And the 90% plus of those parts are USMCA compliant. And if they're compliant, they're fully exempt from tariffs. So when we think about U.S. domestic manufacturing and imported parts flow, I don't think the U.S. manufacturers are at a disadvantage because they're already getting full exemption on the parts they need. We do have a significant amount of parts that do come from Europe and Japan, Korea, but they serve those automakers in their, the European and Japanese, Korean automakers in the U.S. And they, so For Japanese automakers importing, their fair share of parts from Japan, this is a benefit. This is no doubt a benefit.
Just clear as mud. I mean, honestly, this is just sort of amazing to see how, yes, we have some clarity in terms of the actual level of tariffs, but what that means for implementation, a real question. And John pointed to this earlier, and I thought it was a great point, that what we're hearing out of Texas Instruments, we have no idea how much was it bringing forward of demand. We don't know exactly what this is going to do to the supply-demand dynamic versus the conviction that we're seeing in the shares of Toyota seems sort of a contrast that's hard to square. Do you think that companies have enough certainty, not just with where the tariff rate is, but what the response will be in the supply chain as well as consumer demand on the back heels of that?
Yeah, I think companies in the auto space have have their respective tariff exposure sized up, right? One question mark is, to make matters a little bit more complicated, there's a rebate. There's a tariff parts rebate up to 3.75% of the MSRP that all automakers will enjoy. So that really negates the whole parts import tariff headwind. So the tariff headwind that we really need to navigate are the vehicles that get imported, right? The complete vehicles that get imported. I would say, yeah.
Can we turn to the EV market? How's that doing right now?
So with the big, beautiful bill passed, you're going to see the $7,500 tax credit go away effective September 30th. You'll have we have the relaxed emission standards. Right, CARB has their waiver revoked, so automakers don't have to contend with the 17 states that were enforcing CARB. You also have the CAFE, the fuel economy standards, which now have a zero fine, so non-compliance, you don't have anything to worry about. The third and final piece are EPA standards, which likely get rewritten officially mid-next year. And what we're looking at with the big beautiful bill, you're going to have the removal of the subsidy, so that hurts EV demand, and automakers won't have to produce and sell EVs because of the relaxed emission standard.
What is Mary Barra's commitment now to EVs?
So GM had a lot of momentum built up ahead of the presidential election on EVs. Now, and this is part of why I think GM trades at its trough multiple on trough earnings.
Yep.
It's because they had line of sight to $2 billion plus of EV loss improvement, getting towards break even and eventual profitability. And now that gets wiped clear, right? And so there's definitely a contingent of investors that view that $2 billion EV loss improvement as the gap that can't get refilled. What I would say is let's just say GM is 200,000 units below plan for next year on EVs. That 200,000 gets filled by ICE, which is profitable. And if you factor in 200,000 ICE at a 30% flow through, you're looking at almost $3 billion of profit for GM on ICE, which fills that gap of EV loss improvement.
Is there a better company, though, in a better position to take advantage of where the market is right now and where consumer demand is? Because I think that's also always been the counterpoint against GM, at least over the last several years, is that they were too aggressive with EVs, and some companies were offering a better mix. They were in the right place at the right time, in a way that GM wasn't.
Yeah, I mean, focusing the answer on the tariffs outcome, how this plays out, right? I do think Japan's trade deal is a great example.
Sure.
Tariffs get relaxed. Which company stands to benefit the most from a relaxed tariff scenario? It is GM, right? They're talking about a $4.2 billion in annualized tariff impact in the current trade environment. There are substantial scenarios there for dramatic earnings improvement from tariffs relief.
James Picariello there of BNP Paribas. James, appreciate your time. Thank you, sir. Top pick is GM. As it gets that tariff relief, some more relief this morning, potentially, if we get more deals like the ones we just got between Japan and the United States. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Staying on trade, the European Union is preparing to impose 30% tariffs on $117 billion worth of U.S. goods. The tariffs will be implemented if a deal is not reached by August 1st and the U.S. implements its own levies. Sources telling us here at Bloomberg, U.S. industrial goods such as Boeing aircraft, cars, bourbon, and whiskey would be subject to the tariffs. Meanwhile, there is increasing speculation that Japanese Prime Minister Shigeru Ishiba is set to announce his resignation, this following a historic electoral setback. However, the embattled leader continues to deny the reports. And AT&T delivered better than expected second quarter earnings. The company added more than 400,000 mobile phone customers, blowing past the 301,000 expected, as perks and other incentives allowed it to take customers from its rivals. Still, the stock is falling 3.5% in the pre-market, maybe because it's had a 20% run-up so far this year. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next, Fed Chair Jay Powell holds on.
We have a real terrible head of the Fed. He's either evil or stupid, and either is really not acceptable. But he's not doing a good job, and but he's only going to be there for a short while.
Up next, Hoxha of BNY Investments Newton, live from New York City. You're watching Bloomberg TV. Live from New York City this morning. Good morning. Equity futures on the S&P 500 shaping up as follows. Positive off the back of a trade agreement between the US and Japan, up by 1/3%. On the Nasdaq, up by 0.1. Under surveillance this morning, Fed Chair Jay Powell holds on.
We have a real terrible head of the Fed. He's a stiff. He's a knucklehead. He's hurting people that can't get houses because they don't have mortgages. And I don't know if he knows it or not. He's either evil or stupid, and either is really not acceptable. But he's not doing a good job, and but he's only going to be there for a short while.
Here's the latest this morning. President Donald Trump continuing to bash Fed Chair Jay Powell as the Treasury Secretary Scott Bessent doubles down on Fed scrutiny.
The president said he is not going to fire Chair Powell. What I've come out and said is that I believe that it would do Chair Powell a favor, and he would be doing the institution a favor if he did an internal review, separate monetary policy from everything else. This mission creep from the Fed is endangering their independence of monetary policy.
Joining us now here in New York, Hoxha of BNY Investments Newton. Ella, good to see you.
Good morning.
Welcome over from Europe. So please, share the European perspective. You've been watching this playing out in the United States. What's the view over on the continent?
Well, I mean, concern, worry, and obviously trying to figure the sort of environment we're navigating and what happens going forward. As we know, the news flow has been pretty heavy, which is, I guess, good for newsmakers, but for markets, creating quite a lot of uncertainty for our clients as well.
Do you see an erosion of operational autonomy at the Federal Reserve, or is this all just noise?
I mean, it's important to distinguish the signal from the noise. And I think from an investor's stance, there's quite a bit of signaling here of potentially the desire to lower interest rates and potentially looking at lower real rates in the future. Good news for some asset classes, but perhaps for fixed income, my natural home, less of a benign setup. So you have to think about it in that dimension, I think.
And we'll get into just Fed policy rates and inflation in just 1 second. But I'm curious from the European view, how many of your clients are less interested in buying treasuries as some sort of base or are looking for ways to diversify, haven't yet pressed the button, but have plans to over the next 6 months, 1 year, 2 years?
I mean, it's not substantiated by evidence right now. So we're not seeing that sort of sell flow that we're discussing. And in fact, actually, European clients, Asian clients as well, hold far more U.S. equities, in fact, than fixed income. So it's perhaps more of an equity question, I guess. So what happens going forward? Do you continue to buy at the same pace? Do you hedge your exposure to the dollar? Those are probably some of the questions our clients are asking us. But we haven't seen the dynamics of flow that are suggesting things have flipped over. But there's certainly more uncertainty on the future path.
Well, for the United States, but globally for fixed income, there was this real question raised implicitly by the auction overnight in Japan of 40-year government debt that was the weakest performance since 2011, led to record high yields, and it led to this real question: are we seeing the bill really come to the fore for all of those years of borrowing to fix all the fiscal problems? Do you see this as a sea change, that isn't going away, that yields are just going to be structurally higher for developed markets.
Absolutely, yes. We're definitely in the camp that believes at some point we have to face this debt crisis. Maybe it's too early to do so now, but you do see the dynamics of what's happening in the long end of a lot of the bond markets. You mentioned Japan. Japan absolutely is the case in point. Technically, it's broken to the upside. Something similar happening out of Germany in the long end, and in the US, we are also flirting technically with that level as well. So this is a global phenomenon. It's a concern around who's going to finance these large deficits across the world.
You used the word crisis. What makes it a crisis?
I should have probably stayed away from that word, but big mistake. No, but I mean, look, I've lived through the European crisis, so we've seen a debt crisis play out, and we traded it. Those of us who were around. It's a worse setup in some ways, right? Because since the pandemic, the debt levels across the world went up, and I think everyone understands that at some point you have to pay those bills, and the difficulty is we cannot probably afford to do so. And so you're looking potentially, that's why this discussion around the much lower borrowing costs from governments come to the fore. And what that means is potentially you are looking at that setup, but bond investors will demand more premium across the curve, right? So you could probably suppress the short end of maturities, but the long end still will stay elevated. And you also bring ramifications for currencies to the forefront as well.
Are some of these nations already falling into a so-called doom loop? And by that I mean they've raised taxes, it's hurt the economy, that's damaged tax receipts, they're raising taxes, it hurts the economy, that means tax receipts go down again, and they keep going and keep going. And I'm thinking of the UK. Is it just the UK, or is it other countries too? And does that make you hesitant about holding those nations' bonds?
Yes, the UK has been super interesting, and it's a great example to bring to the forefront, because actually whenever the market puts pressure on gilt yields, you see pressure on the currency as well. And we saw something similar in Japan as well recently. Perhaps you could argue even in that turmoil of April with treasuries and the dollar, there was some dynamic. So those are probably early signs of exactly this point. I don't know, I'm not keen on timing things, but the future direction seems to be more clear that we potentially are headed for something like that. Now, because of this difficulty in sustaining this dynamic that you mentioned, the easier path is always one that leads to potentially more inflation down the road. And so I think that also explains part of the reason why precious metals are doing so well in this environment.
Well, but it's a good question whether the UK is sort of a story unto itself, or whether it's representative of a new dynamic where developed markets trade more like developing nations, where suddenly bond yields go up, currency weakens, and you have the same kind of doom loop that John was talking about in the likes of Japan, in the likes of the United States.
Yes, and this is exactly right. I think sort of being situated in DM, you think this kind of setup can never happen here in terms of what we've seen in emerging market economies. But actually, I do think it's exactly the kind of setup we might see over the next 2 to 5 years for exactly the same reasons that you point out. And the fact that we're unprepared probably makes it even more, I don't want to use the term dangerous, but at least we should figure out how do you, and I used to joke actually when we were hiring in my team previously, I was saying maybe we should look for some Brazilians to join the team because at least they've traded in inflation, so they'll understand this better, but certainly people with a more of an emerging markets mentality to them.
Or if you're following the situation with the Federal Reserve, maybe someone from Turkey who experienced the last several years over there as well.
Absolutely, big fan of Turkey.
It's the kind of experience you need at the moment,
Oh,
right?
man. Well, that's the concern. That is the big example.
On a serious note, EM-type dynamics taking hold of DM in many ways over the last few years.
Yeah, you point to the United Kingdom, and yesterday it was clear that the amount they were paying on interest payments was just superseding expectations, causing them to raise more debt, causing yields to go up, causing their interest payments to go up, causing the tax receipts to not necessarily be able to plug that hole. The currency goes down, yields go up. It is a toxic brew, if you will, and I will use the word, a crisis in the making. Yeah, and that's exactly what people are worried about.
You've said this a million times. What don't they want to do? They don't want to cut spending, and that's the issue. The Treasury Secretary, Scott Bessent, has talked about this so many times with regards to the US. He'll say, we don't have a tax problem. We have a spending problem. And the UK has a similar issue.
So how do you emerge from this? Is it, to Ella's point, just some sort of inflationary boost that's going to be a dramatic reshaping in developed market currencies and developed markets more broadly than a lot of people are realizing?
As we've seen from the present government in the UK, it's kicked the can. They don't want to cut spending.
Of course not.
Until this gilt market really starts to bite, and maybe we haven't seen that yet. To your point, crisis potentially in the making. Ella, it's good to see you. Thanks for dropping by. Appreciate your time. Ella Hoxha there of BNY Investments Newton. Up next on the programme, Jack Caffrey of JPMorgan Asset Management, the US Commerce Secretary Howard Lutnick, Lisa Hornby of Schroder's, and the US Senator Bill Hagerty of Tennessee.
AI bullishness is there. I don't think that has changed.
Technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter.
We've obviously had a long streak of really very little volatility.
This whole rally has been fought. The S&P is not the same as it was 25 years ago.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning, good morning. Equity futures on the S&P adding some weight to the rally, up 1/3% on the S&P 500 after closing at all-time highs in yesterday's session. On the Nasdaq, up by 0.1 as we get a deal between the United States and Japan. Coming up later on this afternoon, two earnings reports in focus. Numbers from Tesla, numbers from Alphabet, kicking off Mag 7 results after the close.
And this really is going to be the most important aspect of earnings season, which really is heating up this week, the second busiest week for earnings for the entire quarter. A question of just how much optimism do big tech companies have at a time when they have been thought to be the secular gainers that have driven the entire market higher despite some of the noise around tariffs, despite some of the uncertainties that still remain.
And as we get some deals with Japan and other countries, how forgiving will we be of potential bad news further down the road? Because people might just say that's a reflection of all the volatility, policy volatility of the last several months. We've got the details now. Focus on 2026.
It depends. And this is sort of what we're learning company by company. We're hearing, for example, General Motors talk about $1 billion hit to their bottom line because of their absorption of some of their tariffs. At the same time, Texas Instruments comes out yesterday and says we don't know how much of the really robust demand we already saw in this quarter came from bringing forward demand ahead of tariffs, and their stocks are falling out of bed. Go figure. What do people want to tolerate? It is unclear, and it kind of does feel like it's a stock-by-stock story.
Stock is getting hammered. It's down by 9% in the pre-market. We've brought up this dynamic a few times on this program. Just a bit of tension between what's happening there with Texas Instruments and what's happening with the euphoria around the global auto market stocks throughout this morning.
Yeah, and just to put some context into that, Texas Instruments produces some of the components for cars. And that was one of the questions about how much those were brought forward to avoid some of the tariffs and the tariff impact going forward. So do we have the clarity from auto manufacturers, even if you do have a tariff rate? Is that enough to understand the clarity of how that gets transformed in terms of company demand, in terms of corporate demand, in terms of just how they really access certain components? You can understand something on paper, and I still don't understand it on paper, and I don't think ChatGPT does either, because I've been trying all morning. But to really play that through the market is another story.
Futures positive by 0.4%. Coming up this hour, we'll catch up with Jack Caffrey of JPMorgan following a fresh record high. We'll speak to Aditya Bhave of Bank of America on the impact of tariffs on earnings. And U.S. Commerce Secretary Howard Lutnick with the U.S. striking a trade deal with Japan. We begin this hour with our top story. President Trump reaching a trade deal with Japan.
We had some discussions about the overall U.S.-Japan relationship, which was one of the strongest in the world. As only President Trump could do, he brought the Japanese trade delegation into the Oval and had a very fulsome negotiation with them. And I tell you, they're tough negotiators, but President Trump's tougher.
Joining us now is Annmarie in the nation's capital. Annmarie, fantastic exchange with the Treasury Secretary. The Europeans have one question on their minds this morning. What does it mean for us?
Well, it sounds like, listening to the Treasury Secretary, they need to come up with innovative financing, Jonathan, in order to get a deal over the finish line. That is something the Treasury Secretary said really got this deal done. This idea he talks about, they came up with an idea of a Japan-U.S. partnership where they're going to provide equity, credit guarantees, and funding for major projects in the United States. He said all of this FDI is brand new capital. And it seems that was what the president was more so willing to lower that 25% tariff on autos to 15%. And then Japan seemed willing to take the 15% overall. One thing is key that Kellyanne Shaw mentioned earlier in the program. When it comes to the United Kingdom, they had a lower tariff rate on autos, but it was capped. There's no cap now when it comes to Japan. That seems to be a really big concession. So now if you're the European Union and you're looking at, we have August 1st to get through, that is basically a week to try to finalize this agreement. They're looking at this potentially as a playbook. What could we do in terms of investments in the United States? But one thing seems very clear to me. They are not going to get under 15%. We should note as well, this seemed to be a shock for a lot of people in Washington. They weren't tracking a deal to get done so quickly when it comes to Japan. And potentially things are most tense at the end of a negotiation. We have a story out by our European colleagues today that the EU is readying 30% rates on about 100 billion euros worth of goods in retaliation. The Treasury Secretary says he would be doing the same. So maybe they're taking their negotiating cues from the Oval Office.
Annmarie, appreciate the update. Looking forward to your conversation later on in the hour, about 40 minutes from now. We'll catch up with the Commerce Secretary, Howard Lutnick. For the Europeans, there's a deal available to them. LNG purchases. Just write the cheque, come out and say you want to buy X amount and move on, accept the 15% and get it done.
Oh, you want to go negotiate it for them? You want to come up with this innovative deal that Japan
Isn't that
did?
just like the door's wide open?
Is it?
Like, just like walk through it.
You know, that's a question. I wonder whether it is or whether there's some sort of other type of gripe that is at the heart of this.
It's personal.
Chickens, cars. Why don't you like our food? I think it is. I think that there is an element of
chlorinated chickens.
Why don't you like our chlorinated chickens?
Why won't you eat them?
Great. Why won't you eat our eggs?
Let's have a purchase agreement around chlorinated chickens.
We have a purchase agreement around
Just
rice.
have a big bonfire in the middle of Berlin or something, all right?
I'm telling you, this is seriously, it feels more personal. It feels like you have really pinpointed us as the evil players. And so, tell us that we're good. And
I'll stop joking around. I agree. Actually, I do agree. When you listen to the president carefully, the kind of things that he says about German automakers and how many he sees in America and how few he sees of US cars over there, this is a point he's been pushing for a long time.
Yeah, it's sort of this feeling that maybe there's a superiority complex that he's trying to kick into. I don't know. I'm not going to get into the psychology. I'm just going to say it does feel a little bit different with Europe than it does with Japan.
Worth pointing out, a lot of German autos are produced in America.
I know.
Made right here.
One of the issues.
Here's the view on Wall Street this morning. Jack Caffrey of JPMorgan writing, the rally suggests traders are expecting another positive quarter of earnings and sales upside against forecasts. Jack joins us now for more. Jack, good morning.
Good morning.
How low is the bar?
As you were talking right before you got to me, it's very almost stock specific. I mean, earlier this week we heard from, a semiconductor company that sells to the auto industry. They were down 6%. Last night we heard the update from Texas Instruments. Good numbers, weak guidance. They're down 9% this morning. Which doesn't feel like it's supposed to be shocking after what we'd heard earlier in the week. And at the same time, you're seeing names, but the average company's up 1% the day after their report. So on the whole, things are quite nice, but the fact is there are a lot of potholes and seeming landmines that people are still stepping on as we work our way through this. And I think at some point over the next month, we're going to be spending more of our time talking less about 2025 and the very modest expectations for 2025 and talking about how things accelerate so dramatically into 2026. That hope for we get policy certainty at some point or policy consistency.
Is that all you want? Just consistency?
I just want to know what the rules are.
And then we'll move on.
I think ultimately U.S. companies are exceptional at driving profitability once they understand what they're going to operate under. If we went back to the first Trump administration, a lot of focus on trying to get tax policy, and then you created a trade war within days later, and for the most part, companies sat on their hands in terms of thinking about their investment. Today, now we actually have some tax clarity. That's the good news. Ideally, we'll get some trade clarity that might lead to actually understanding where investments go. But at the same time, I think I and other investors thought that perhaps when you looked at where prior budgets were allocating capital in terms of trying to think about subsidies and goals, a lot of that's now been thrown up as you've ripped up parts of the goal of electrification, say, in the One Big Beautiful Bill. So I don't know if the battery complex of Georgia makes as much sense. If the EV manufacturing in Tennessee makes quite as much sense on a go-forward basis if the cost structure underwriting those investments is as durable as we initially thought.
On a broad market basis, have we priced in the certainty before we've gotten it?
It kind of feels like it when you think about, implied volatility effectively at year lows. If you look at put buying, that's running at sort of year lows. If you average it, not any one day's number, but smooth that out. If you look at corporate credit spreads, again, at 52-week lows. So for the most part, I think risk markets are saying, we got this. And I think that's where things get trickier, especially as we go into the next month or so, when liquidity does tend to be a little bit punkier overall, and people try to go on vacation.
Right. Well, this is sort of the buy the rumor and sell the news, and a question about whether you agree with Julian Emanuel over at Evercore ISI when he came out earlier and he said he sees the next move in equities to be something like 7 to 13% lower. Do you agree with that?
Having not read the note, I'm not sure what he was looking to. I think
on a theoretical basis, do you agree with the lower?
I think now next, call it 60 days, I think it's going to be hard to get a big rally unless you get something truly dramatic in the way of blowout sorts of news. I think underpinning that, though, we're looking for a mid-teens growth in earnings coming out of the Mag 7. I think the trick is that the forlorn 493, we're supposed to have earnings growth of like 3 or 4% for the course of this year. That accelerates to 12% next year. So actually the momentum in earnings is shifting away from the Mag 7 into the forlorn. And I think that speaks to a stable, growing economy. And ultimately, I think maybe we spend too much time talking about the economy does this. Look at the consumer. The consumer continues to work. The consumer continues to spend. And I think that's really the flywheel that people really need to pay the most attention to, because it's that stable consumer spending that's driving the earnings and cash flow that underpins the transition to AI. When you think about who the capital spenders are versus who the capital providers are, it's the consumer keeping working and spending every dollar they get.
I'll bite, Lisa. That 7% call of Julian, 7 to 15, whatever it was.
15, yeah.
There's a common theme, I think, for a lot of the analysts who are making this call at the moment, is that they want to buy it. So they'll say, I expect the equity market to have a drawdown of maybe 10%, but ultimately I want to buy the dip. Heard the same thing from Mike Wilson of Morgan Stanley. Exactly the same. So the same thing from Goldman Sachs. They said, we anticipate a less favourable growth inflation mix in the second half, challenging the Goldilocks scenario. Still neutral and still moderately positive on stocks over a 12-month time horizon. I see that on repeat across Wall Street.
Yeah, how pessimistic can you get when ultimately you're talking about a drawdown? That's going to be a great opportunity. Please sell off so that we can buy it. It raises this question.
I mean, let's remember also that we also have a Fed that's planning to cut. The debate might be, do they cut in July or are they cutting in September? But the Fed is trying to be our friend. They are actually moving in a direction that tends to be risk supportive. And so, having started as a strategist and having to live by trying to get the timing right, I appreciate being a portfolio manager and getting to step a little bit away from the noise and be like, what's the main thing? And let's focus on the main thing. The direction remains, a growing economy, growing earnings, and cash getting returned. Less cash probably gets returned to us as investors going forward when you think about the massive investment demands that we're starting to try to underwrite. And I think that's going to make things, perhaps a bit trickier and where you have to deliver versus it would be nice if you delivered.
And a bias to reduce interest rates, as you say. Jack, appreciate your time. Jack Caffrey of JPMorgan. The Fed's still a friend of this market, and maybe the president gets his friend in the Federal Reserve next year, you're going to see even bigger rate cuts.
Yeah, which friend? I mean, I think that's going to ultimately be the question. Is it the Kevins? Scott seems like he's kind of on the outs just because he's doing a really good job running the world. I mean, ultimately, come on, it's almost like a downgrade for him at this point.
He doesn't sound interested, does he?
I mean, well, you could call it the Oval. No.
Listening to him talk about that situation, though, that list is longer than I thought it was, maybe. Regional Fed presidents, Fed governors in the mix.
Strategic ambiguity?
Don't know.
Yeah, I mean, is it trying to just... the biggest takeaway to me is they're not in a rush. And that means that they can consider all these potential other candidates rather than to rush into the Kevins or rush into the Waller. And that, I think, is the real big takeaway, which is in direct contrast with what we're hearing from President Trump.
Just calming things down.
As he always does.
For this morning, at least. Equity futures positive by 0.4% on the S&P with an update on stories worldwide. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. The European Union is preparing to impose 30% tariffs on $117 billion worth of U.S. goods. The tariffs will be implemented if a deal is not reached by August 1st and the U.S. implements its levies. Sources telling us here at Bloomberg, U.S. industrial goods like Boeing aircraft, cars, and bourbon and whiskey would be subject to the tariffs. Meanwhile, Qatar says it will bid for the 2036 Summer Olympics. It wants to become the first Middle Eastern nation to host the events. Qatar is facing competition from other countries, including Turkey, Indonesia, and Chile. The nation says it is well positioned to hold the Olympics in its capital, Doha. And Starbucks opened free study rooms in some of its China stores to try and boost traffic. The company is taking a different approach in China where customers won't have to buy anything to use the spaces, unlike here in the U.S. Sources telling us here at Bloomberg, Starbucks China has also expanded its drinks menu to lure Gen Z customers. That's your Bloomberg Brief. John?
Hara, thank you. More from Yahara in about 30 minutes. Up next, the morning calls plus Aditya Bhave of Bank of America on the path for interest rates. Live from New York, You're watching Bloomberg TV.
We are making good progress with the EU. The EU has a collective action problem. 27 countries. We are the deficit nation. They're the surplus nation. So any kind of a escalation in trade problems will always hit them worse.
The Treasury Secretary, Scott Bessent, on the potential for an agreement between the United States and the European Union following the trade deal between the US and Japan, igniting this move in the equity market. This move worldwide. Big rally in Japan, rally here stateside, up by 0.4% on the S&P, on the Russell, up by 0.9. That's the price action. Let's get you some morning calls. First up, TD Cowen raising its price target on Capital One to 260, citing solid growth in its credit card portfolio. That stock is up by 2.6%. Your second call from BofA, raising its price target on Amazon to 265, citing Anthropic AI growth ahead of earnings. That stock is up by 0.5%. And finally, Mizuho lowering its price target on Texas Instruments to 200, noting its muted outlook due to auto and tariff headwinds. That stock is down by close to 10%. Let's stick with tariffs. GM and Nokia also reporting increased costs due to the levies. Aditya, Bhave, Bank of America writing, with the stagflationary shock possibly extending into 26, it becomes more likely that the Fed will be frozen in place, consistent with our at a consensus call of no Fed cuts this year. Aditya joins us now for more. Aditya, good morning.
Thanks for having me.
Is that a dual mandate in conflict by the end of the year?
It could be. So there's interesting stories on both sides of the dual mandate. On the unemployment rate, the big question is how much of the slowdown that we're seeing in job growth is supply versus demand. And if you look at the U rate over the last year, it's been flat. If you look at the ratio of vacancies to unemployed workers, it's been flat. So that suggests that a lot of the slowdown is supply, which makes it less necessary for the Fed to respond. And on inflation, I think there's two issues, and those are the issues that we would take with Waller's view on inflation. One, underlying inflation, I think, is stuck at around 2.5%, not close to 2%. That's ex of tariffs. And two, there's a question about the persistence of the tariff shocks, especially the pass-through of tariffs, particularly as you get these continued kind of ratcheting up of tariff rates.
2 points there to address the dual mandate. Do you have a higher conviction view on one side versus the other?
That's a good question. I think probably higher conviction on inflation. The labor market is very much in flux right now.
At this point, can we really say that we have certainty and that we can start pricing in the actual effective tariff rates in a way that we didn't have the capability of doing, say, 2 weeks ago?
We certainly don't at this point, because we at least need to see how the 1st of August plays out. But even as you get past that, I think there are certainly risks that we could continue to see, threats of tariffs or actual implementation of tariffs that are a little bit higher than expected. I mean, after the 9th of April, we assumed that 10% was the baseline rate, but now higher rates are on the table. There's 15% or 19% as a baseline for many countries.
You said that you have more conviction about inflation being higher on the backs of tariffs, but also some of the other influences in the economy. Is that okay? I mean, people talk about it like it's a negative, but maybe we need to have a higher inflation rate given the fact that we have a lot of debt. It used to be inflate ourselves out of that, right? That used to be the mantra, and we see that on a global basis in developed markets. Why isn't this actually the cure to a lot of those problems?
It could be. I don't think 3% inflation is disastrous for the economy, and I don't think 4.5% policy rates are disastrous for the economy either. It's just that the two go hand in hand.
Do the threats to independence right now make it harder to reduce interest rates?
That could be the case. I think most of the Fed is probably just focused on its job. And again, I mean, instead of thinking about that, I think it's easier to just think about the fundamentals. And I don't see the fundamentals on inflation right now supporting rate cuts. So the idea would be, okay, we had these April tariffs. There's views from the Fed, like New York Fed President Williams, saying just the April tariffs could continue to affect inflation into early next year. Now you have this additional round in August. When does that fully play out in prices? Is that the middle of next year? At what point do we stop saying this is a transitory shock?
Why wouldn't it be a transitory shock, even if it continues into next year? What's the time horizon for transitory, I guess, is the
exactly. That's the question, right? And if tariffs keep kind of ratcheting up over even a couple of years into the midterms, then when does transitory stop being transitory? Is it 2026, 2027? I don't know, right? And again, underlying inflation to us looks like it's around 2.5%. It's not 2%. So if the Fed wants to maintain its credibility, I think it makes sense to stay where they are right now.
You know, you talk about how you're not as concerned about the labor market. You're more concerned about the inflation aspect, and that's something that they should combat more. I'm talking about the Federal Reserve. I just wonder what you're looking at in particular. Is it the ramification from the one big beautiful bill and the stimulus effects of that? Is it the Industrial Revolution 2.0, where you're seeing a huge capital expenditure influx in corporate America? What exactly gives you that faith that there will be that strength on an ongoing basis, even in the face of inflation?
Right. So I should clarify what I said about the labor market. Our view is that job growth is slowing down, but we see that more as a supply story rather than a demand story. So there is some slowdown there, and that'll affect labor income as well. But what makes us feel better just in the last few weeks is the pickup in consumer spending, because ultimately there's this chicken and egg relationship between job growth and spending. So if you look at the July data, June retail sales were somewhat strong. Maybe a lot of that was inflation. You look at July, you had a very good Prime Day, and air travel has really picked up in July as well. So the consumer seems to have rebounded a bit going into the third quarter.
You said something about the supply side of the story,
Yep.
and I thought that it was really interesting. Pantheon Macroeconomics put out a piece challenging the idea that there was this huge exodus of immigrants, particularly illegal immigrants in this country. And they said the actual state-by-state data does not back this up. And in fact, in a lot of the areas that are most sensitive to this workforce, you are not seeing declines in the labor market. Are you seeing more evidence that there is actually that exodus that some people talk about, that really everyone's been surprised that the market's held up as well as it has?
So two things to say about that. I haven't seen the notes, so I can't comment on the details. But again, if you look at the bigger picture data, the best indicators of the balance between supply and demand in the labor market are the unemployment rate and the V by U ratios, vacancies to unemployed workers. And both of those have been flat for a year, even though job growth has been somewhat tepid. So that suggests a supply story, right? And then the other thing to keep track of is that some of these measures have recently been green-lighted by the court. So you could see a bigger slowdown starting even in the next jobs report.
This is the call for 25.
Yep.
No cuts.
Yep.
Have you established one for 26 yet?
Yes.
What is it now?
We think they'll cut by about 100 basis points next year, but there's a lot of risk around that number.
Just help
right?
me understand the 100.
Yep.
Where does the 100 come from? Is that because there's a new Fed chair?
That's part of the story.
So you believe it's just the individual. That's what matters here, not the economic backdrop.
It's part of the story, but I think by late 26, you're also going to have a little more confidence on inflation, right? So right now, the Fed is sitting there and thinking, okay, we really don't know. I mean, what they said in April was, let's get some clarity on the tariff picture, and then we can move. Going into the July meeting, they're not going to have that clarity because the April 1st deadline is 2 days later. I don't even know if they'll have clarity on the economic impact by the end of this year. But presumably in the second half of next year, they'll know more.
So transitory is 12 months.
You
cleared that up eventually.
I think that we have a good understanding. Transitory is the end of 2026, and then they can make a judgment.
Aditya, good to see you. Aditya Bhave there, Bank of America. This is part of the call for next year. It's not just about the economics, it's about the politics. It's the individual that's chosen to lead the Federal Reserve.
So at this point, you could say that there is a political sheen to the Federal Reserve. You can make the argument there always has been. This isn't new, but it really shows how this is moving markets in a significant way and expectations even before Fed Chair Jay Powell departs.
I wonder if the president's conditioned by his last pick, which was Chairman Powell. That was the sensible pick at the time. Go with someone on the committee, elevate them, and whether that holds back the president from selecting Governor Waller at a time when a lot of people on Wall Street would like to see Governor Waller become the next Fed chair.
Well, evidently he's got some regional Fed presidents to choose from.
They?
So, let's get our trees out and start thinking about that.
Coming up in the next 30 minutes or so, don't miss this conversation. Annmarie catching up with the Commerce Secretary Howard Lutnick in Washington, D.C., following a trade agreement between the United States and China. A deal struck overnight that's unleashed quite a rally in Japan and a decent rally stateside too. From New York City this morning, good morning and welcome to the program. Equity futures positive by 0.4%, a two-day winning streak into Wednesday, all-time highs. On the Nasdaq, up 0.1%. The next stop for this market, Alphabet and Tesla, after the closing bell. Check out fixed income, 2-year, 10-year, 30-year, 10-year bond yields falling for 5 consecutive sessions coming into today. Yields rising today by 2 basis points, 4.36 on a 30-year, up by a basis point or 2 to 4.93. Dragged higher by this, Japan. Japanese bond yields higher by 5 basis points at the long end of the curve, make it 8 basis points at the ultra long end of the curve. The conversation about Japanese debt, this isn't about the trade agreement, it's about the future of the Prime Minister and a messy debt auction.
There is a rumor, it has been reported by local media, that Prime Minister Shiba is going to resign, is going to step down after the disastrous election for him and his loss of popularity. Who gets in that seat? Is it somebody who wants to cut taxes in the face of higher debt spending and concerns about a slowdown? That is not what bond vigilantes want to hear, and they are protesting this morning.
Protesting this morning, and maybe that bleeds over to the United States at exactly the wrong time.
Well, this to me is really the question. Do we have a bond vigilante issue on our hand, or don't we? Are they on the sidelines, or do people, actually really like the income and they're going to come into these developed markets regardless? And that is one of the big conundrums heading into 2026, the remainder of this year, simply because yields are high, but then people say, okay, but we want them. And we hear that from Bob Michael all the time.
I was thinking of Bob, exactly. That's who was in my mind earlier this week. Bob Michael of JPMorgan Asset Management, who just talked about this wall of money coming into fixed income. That's the global debt market with 60 minutes until the opening bell. Let's get you some morning movers. We can catch up with Yahara for that. Hey, Yahara.
Hi, John. We start with the toy and game maker Hasbro. Shares are now down 4.4% because apparently good is not good enough. The company gave a strong second quarter and said that it's boosting its full year's outlook. The company cited ongoing cost cuts and saying that it had record results in its Wizards of the Coast unit, which I just learned makes the games like Dungeons and Dragons. Analysts say that the quarter beat even bullish expectations, with JPMorgan calling the updated forecast conservative, yet shares are still lower. Next up, we have the auto stocks. They are having a bit of a relief rally here after the U.S., of course, struck a trade deal with Japan, with tariffs not as bad at 15%. But the reason Stellantis is rising so much, 6.5%, is it imports a significant portion of the vehicles it sells in the U.S. from overseas. And what this U.S.-Japan trade deal does is it provides some clarity for the automakers, and some analysts say it could be a blueprint for any EU-U.S. deal. And we're starting to see the knock-on effects from Texas Instruments' weak outlook. Take a look at on semiconductor, NXP, all falling since, like Texas Instruments, they make chips for the auto and industrial sectors. The worry here is what Texas Instruments has to say, that it still sees no signs of recovery in the auto sector, and it doesn't know how much of a pull forward, as we've been talking about, due to tariffs contributed to those strong results it saw in the second quarter and what it means moving forward. John?
Yahara, thank you. I think a question this morning for the equity market. What do you believe in more? The sell-off in Texas Instruments or the rally in global automakers?
Put perfectly. Do you sort of hinge your bets on the ability to plan for the future, or the reality that in the near term, we've already brought forward so much of that demand? So it's going to be maybe tepid for the next 6 months.
Some interesting movers for you this morning. More interesting ones after the closing bell. We'll hear from Alphabet and we'll hear from Tesla. Let's turn back to fixed income. The US 10-year Treasury yield rising on weaker safe haven demand as US strikes a trade deal with Japan. Joining us now is Lisa Hornby of Schroder, who writes the following: the curve has moved a long way and could be due for a pause. Lisa, good morning.
Hi.
It's good to see you. That trade agreement with the US and Japan, is that good or bad for bonds?
That's an interesting question. By itself, I guess you could say it potentially maybe is bad for bonds. I mean, yields are moving up higher. I think the bigger picture is that yields in Japan are moving higher. And so we're in a global world. And I think you have to think about, if yields elsewhere are moving higher, that potentially reduces the demand from overseas investors for U.S. fixed income. Now, I'll note, everybody was super bearish on demand for U.S. fixed income a few months back. Nobody wanted anything in the U.S. We'd see a buyer strike. The tick data has showed, and other data has showed, that that's not happening. But sure, higher yields abroad potentially reduces some incremental demand for the U.S.
You took it to Japan, so let's stay there.
You took it to Japan.
The move in Japan, is that because of what we've seen with the trade agreement, or is that because of what might happen with the Japanese Prime Minister and what happened with the debt auction?
I think it's a combination of things. I think it also potentially moves policy back towards maybe a more hawkish position than it would have been outside of a trade deal. So I think the confluence of factors suggests bond yields in Japan can continue the rise that they were doing previous to this last couple of months.
There is this dynamic that seems to be evolving where investors are getting skittish about the unwillingness of governments to pay their debts. And we've seen this in the United Kingdom, we've seen this on the margins in the United States, and we certainly are seeing that in Japan. How far does that go, right? Because at a certain point, if people are getting income that they haven't gotten in the past decade, they're going to like it, akin to what Bob Michael of JPMorgan Asset Management keeps saying.
I mean, I was listening to your comments before, and I think this is an amazing time in bond markets, right? It's probably the first time, maybe not the first, the last couple of years, it's been exciting to be a fixed income manager because we have income, we have yield. You know, you can buy relatively safe, high quality assets and produce a significant amount of income over the next several years. You also have the potential for capital appreciation. Eventually, we'll enter a cutting cycle. I heard your previous guest, you know, maybe it's next year, maybe it's at the end of this year, but at some point, rates will be coming down, and then you have capital appreciation on top of that. So I think it's an amazing environment. I'm less concerned about the inability to pay debts. I do think curves generally, longer term, are biased towards steepeners because there does need to be more term premium. And I think a good degree of that is reflected in the immediate present. I think a lot of people are positioned in curve steepeners. I think we've had a lot of the bad news with regards to deficits and how big they are. So I do think there could be a tactical pause there. But longer term, yes, I think you need to embed some higher inflation risk premium. I think you need to embed some higher, you need to demand a little bit more yield to buy the long end. And I think broadly, that's what we've seen in markets.
You know, I remember 2 years ago, people would have said that when we got yields at this level, there would be people who would say, why should I own stocks? I'm going to go into bonds. I'm going to get that income. You're not hearing that as much anymore. Now people are saying it's an inflationary environment. You're pegged to this sort of industrial revolution, the AI outcropping. I mean, at what point do you start to see stock investors go into bond investors, or is that relationship just totally broken down?
I think it's broken for the moment until we have some sort of correction. And corrections are natural. We forget that they exist, but they will exist again. And I think it's at that point that we see this rotation into bonds. I mean, look, we're saying bonds are unloved, and yet every corporate deal that comes to market recently is multiple times oversubscribed, 5, 6, 7 times oversubscribed. Compare that to history, it's probably closer to 3. So we're seeing a lot of demand, even, as people are saying, oh, we're worried about bonds. Certainly the retail market might be worried about bonds, and we're seeing that in the municipal bond market. But I think broadly, there's a ton of demand out there, and that's what's supporting credit spreads, for example, at the very, very tight end of their historical range.
High yield spreads 280 right now, south of 300 basis points, super, super tight.
Yeah, but people see further spread tightening going forward just because companies are doing really well, they're adapting and adjusting, and consumers are still spending. So there you go.
We're moving on, Lisa. It's all over. Moving on to 26 and 27. I find that amazing when 25 is still not settled, that we're moving on to 26 and 27.
Well, it raises the prospect that we've priced in certainty and we've priced in strength before it's happened. And so at what point, again, do you buy the rumor, sell the news? How much are we creating tops that look pretty perilous where they are? And that's, I think, what Julian Emanuel was talking about for a moment that he wants to buy.
Buying the recovery to the slowdown we haven't had yet, which is always a confusing one anyway. Lisa Hornby, it's good to see you.
It's great to see you.
Thanks for dropping by. I appreciate it. Lisa Hornby there of Schroder's. Let's get you an update on stories worldwide. We can do that with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump announced a trade deal with Japan. The agreement imposes a 15% tariff on imports and creates a $550 billion fund to make investments in the U.S. Japan also agreed to buy 100 Boeing aircraft, boost rice purchases, and increase defense spending with U.S. firms. Meanwhile, Microsoft is accusing Chinese state-sponsored hackers of exploiting flaws in its SharePoint software in a hacking campaign. China responding, saying the country opposes cybercrime, but also opposes smearing others without solid evidence. And Morgan Stanley is being investigated by the Financial Industry Regulatory Authority, known as FINRA, over its vetting of clients for the risk of money laundering. The Wall Street Journal reporting the investigation is focused on clients, risk ranking, and other practices. The bank has been working on fixing its client screening practices after the Federal Reserve for years raised concerns. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. So up next on the programme, a must-watch conversation. The US Commerce Secretary, Lutnick, sitting down with Annmarie following an agreement between the United States and Japan, unleashing a big rally worldwide.
15% for Japan for reciprocal tariffs for autos. That is a different kind of deal, but because the Japanese proposed a very innovative solution. We've been working with them for months, the trade team, myself, Ambassador Greer, Secretary Lutnick, and they came to us with the idea of a Japan-U.S. partnership.
Some good news. We're making some progress. That was the Treasury Secretary, Scott Bessent, speaking to Bloomberg Surveillance a little bit earlier on this morning. Signs of progress are moving this market. Equity futures positive by 1/3% on the S&P. On the Nasdaq, up by 1/10%. It's our top story so far this morning. President Donald Trump reaching a deal with Japan, imposing 15% tariffs on imports. Trump also saying Japan will invest $550 billion into the U.S. Annmarie joins us now with a special guest. Hey, Annmarie.
Good morning, Jonathan. That's right. I'm with another negotiator that was at that table with the president last night, Commerce Secretary Howard Lutnick. I want to pick up on this idea, and good morning. Thanks for joining us. I want to pick up this idea of innovative financing mechanisms and this $550 billion fund the Japanese are going to be investing into. What exactly is that fund going to look like?
So the Japanese are going to give America the ability to choose the projects, decide the projects, and execute the projects. So let's say we want to build generic pharmaceuticals, right? We don't make antibiotics in America. So the president says, let's go make antibiotics in America. The Japanese will finance the project. They will finance the project, and then we'll give it to an operator who'll run it, and the profits will be split 90% to the taxpayers of the United States of America and 10% to the Japanese. So they basically bought down their tariff rate by this commitment of we will back what you, the president, want, and you, America, want to build in America that are key to national security concerns. We'll back that, and therefore we'll be on your side.
The Prime Minister, Ishiba, says these are loan guarantees. Is it more than that?
Of course it's more than that. It's equity, loans, and loan guarantees. They have to deliver the project. So we say, let's build semiconductors. We want to build $100 billion worth of semiconductor fabs, is what you call them, because we want to make those chips in America. The Japanese will finance that whole project. They've got to put down equity, loans, whatever they want to do.
With
they have
US
to deliver the $100 billion.
Or Japanese companies?
No. Anybody does it. It's the Japanese are the financer. They're the banker. They're not the operator. It's not Japanese companies. So when people get confused, this isn't like a Japanese company like Toyota coming in and building a factory. No, that's Toyota. This is literally America saying we want to build generic pharmaceuticals, semiconductors, critical minerals.
Does anything
here.
like this exist now? Like, what could we think of and model after this?
That's why you have someone like me who joins the government. I mean, this was my idea in January. So I started, because the Japanese are never going to really open their market the way Donald Trump wants them to open it. I mean, open it. You know, so what happens is they had to come up with another way to really make it work and the tariff model work. So I suggested to them a $400 billion fund where they would give to the president and they would give to America the financing to go build out your whatever you think for national security, go build it, we'll back you, and that's the model.
The reports the Prime Minister, though, may be resigning. Could this deal transcend domestic politics in Japan?
Of course. I mean, it's vital. You saw what happened to their car companies. They were all up more than 10% today. So a 25% tariff delivers what Donald Trump said. Build it in America. A 15% is right on the edge. It's right on the edge. So the Japanese car manufacturers can still produce in Japan. And that's what the Japanese wanted to buy. They wanted to buy that line where they could stay in Japan for some cars, build, of course, huge amounts here. But also what they did is they'll invest and give Donald Trump the tools to invest in America.
That 15% tariff on autos is huge for Japan. Do you see the entire auto tariff, that sectoral tariff, coming down from 25% to 15%? Because for some inputs, this would mean Toyota has a 15% rate, but GM still has a 25% rate.
Well, GM doesn't have a 25% rate unless they build somewhere.
And they import from South Korea or a product from Japan.
If you build in South Korea, you have a South Korea thing. And if you're importing from South Korea, that's a South Korea thing. So Europe is now paying 25%. South Korea is paying 25%. The Japanese have bought, if you will, by giving a huge investment to Donald Trump in America. They bought the ability to be down to 15%, and Donald Trump can then really invest in America on the projects that he thinks are the most important for America. And we'll see what happens with Europe. We'll see what happens with South Korea. But right now, Donald Trump has put the pressure on them. Let's be clear.
Well, is this
He's
a model?
put the pressure on them.
Is this a model for Brussels?
It could be. I mean, that's up to them to negotiate, right? Are they willing to open their market? I don't think anybody. Europe's not going to go and give us $1 trillion to.
But can they get
in
below
America.
15%, or is 15% now the floor?
For autos, I would.
No, for a reciprocal tariff for the European Union.
I don't think
at one
big
point they were willing to
countries-
accept.
I don't think
10%.
big countries can get low like that. I think small countries have a possibility of being low, and that's up to the president to decide. But larger countries will have a hard time with that. They will have a hard time.
So to be clear, with the European Union right now, and the trade negotiations are in Washington, I know you're talking to them every single day. The rate, the floor that they would have to accept is 15%, what Japan accepted.
I think what everybody in the world has seen is Donald Trump. So I'm the table setter, if you will, right? I set the table, right? I organize things. I structure things. There was a picture that the president posted over his shoulder with the big board that, of course, I created the big board and put it there. But the answer is the negotiator in chief of the United States of America is sitting behind the desk.
Right.
Donald Trump was sitting there negotiating the deal.
You also created the board on Liberation Day, and we saw the sky-high tariffs. You created last night's board. I'm trying to understand from you what the European board is going to look like. So if, say it's a 15% across-the-board rate, what could the Europeans be buying that can assuage the concerns of the president? Are you talking about LNG purchases? Is there agricultural purchases?
The Europeans have a $20 trillion economy, right? We have just under $30 trillion. And the Chinese and the Europeans are similar in size at about $20 trillion. So if they say to the president, we will open our market to you, and I mean really open it, meaning we will take U.S. cars, think of what the Japanese did. They said, we will take U.S. cars based on U.S. standards. So you don't have to make a different car. You can take the car you make in Detroit, put it on a boat, and send it. If the Europeans will accept that, and they will accept really, really accepting U.S. products in Europe, that's a giant. That's hundreds of billions of dollars of export opportunity for Americans. That's going to move the president because he's going to say that opportunity for Americans is so great.
Do you
That's
think you get there next week?
Well, we've been talking about it for months. I mean, holy moly, I can't count.
They're saying they're going to retaliate if they don't get a deal by August 1st.
I understand. Then the president wrote them a letter saying, if you don't get a deal done, we're charging you 30%.
This is all negotiating tactics out in public.
Well, of course it is. I mean, Donald Trump writes a letter and says, if you don't make a deal, it's 30%. And the thing about Donald Trump is he's dead serious. If you don't make a deal, it's 30%. Now, that puts the pressure on them, right, to say, okay, that's my alternative. They want to get a deal done. For sure they want to get a deal done. But does Donald Trump want to get a deal done? How much does he value the fact that they open their market? Do they completely open their market? Because that's what he's looking for. I think they will. I think they will really, really open their market. And I mean open it, which is something the United States of America has never had. The idea that Donald Trump is opening the world's markets for Americans, the ranchers, the fishermen, right, our farmers. I mean, these are amazing opportunities that no one in the world has ever seen. We have Stockholm Syndrome, right? The world has so held us off for so long. We can't even imagine a world where we can export freely the way everybody else exports to us. And that world is coming. That's what Donald Trump calls the golden age. That's what he calls it. Our ability to export to the world the way they treat us, we can now finally treat them.
You're going to have to step away from the Europeans, though, potentially for a moment next week, because I believe you're going to be headed to the Stockholm talks with China.
Yes.
So what we saw with China in this administration, Jensen Huang had a conversation with the president. I imagine you were there when it comes to NVIDIA H20 chips. What did Jensen Huang say to you and the president that gave him the green light to start selling those H20s back into China?
Well, the H-20s were open during Biden. So Biden set really
well, they
no
were
restrictions.
developed during Biden because
But they were sold to China.
compliant.
They were actually sold to China. And then we came in and we said, whoa, 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 that's a pretty powerful chip. And
April.
And we held that back. And that was then held back. And now we had the whole magnet thing, which is very exciting. We're trying to make sure that magnets are being delivered to our producers, which was the deal. And these have export controls on them. And they'll come off as the Chinese deliver their magnets, then the H-20s will come off. But it is logical, since they were free to sell last time, it seems reasonable that we'll get to that point.
But you said they were a powerful chip. Are you concerned about national security issues when it comes to allowing the Chinese now to get their hands on the H-20?
Well, the H-20 was the third best chip in the world, and now it's the fourth best, right? Because the Blackwell is the best. There's an H-200 and H-100, so an H-20 is the fourth best chip. And I think the president has decided that if things are going well with China, that they can buy them. So I think that decision's been made. We are putting on the licensing mechanism, and we are getting that going. But the president has decided that the Chinese can buy them, but that's in a balanced way, with the Chinese delivering on the deal that we made with them, and they're delivering rare earths to American manufacturers.
So when you sit across from your Chinese counterparts next week, what do you plan to discuss with them? Is loosening export controls, more export controls on the table?
I think what we talk about is there's a line, right? Below the line, we are giant economies. We should trade with each other, right? They want to buy our produce. They want to buy our vegetables, right? They don't grow everything. They don't have the breadbasket of America that we have. So they want to buy those products. And you know what? There's lots of things that they make that we want to buy, that we want inexpensive things on our shelves. So let's talk below the line. Let's open the market better in China and let us sell more things in China. And then at the line where we're competitive, where is that line where above that line, they're not going to sell us their hypersonic missiles, and we're not selling them our best chips. Those two things are not happening because they're a competitor. They are a competitor. And what we're really going to discuss is where's that line? Are the H-20s above the line or below the line? That's really nuance, and that's discussion. But of course, would we like to buy baby clothes that are inexpensive? Of course we would. That makes perfect sense. So let's open the market down here, right? We're never opening the market up here. And what do we discuss? We discuss that line of what's over it and what's under it. But do we want more of this? Them selling it to us and us selling it to them? The president and President Xi from China agreed that they would like to do more business there. So we're going to talk about opening their market more for things that make sense to open it. And we're really going to discuss the areas that maybe we should really be addressing. Is that yes or is that no?
One area, I just want to finish on this. I'm curious if you're going to address directly, because it's the Commerce Department. An employee of yours is facing an exit ban right now from China. Do you have any update on this?
It's unbelievable, right? So he has, there was an employee of ours who's a Chinese national who was working in the patent office, and he went home and he was arrested, and they're holding his passport. I mean, so I give that to the State Department, and the State Department deals with that. But it is outrageous behavior. It's just outrageous behavior.
Secretary Lutnick, thank you so much for your time this morning. Of course, Jonathan, Lisa, Commerce Secretary Howard Lutnick, who's been integral on all these trade deals, especially when it comes to Japan. He says this was his vision, $550 billion when it comes to that fund.
Annmarie, appreciate the update. Great word this morning. Fantastic conversations. We've made some progress. The market, as always, wants to see more. How much progress can we make? And next up are the Europeans.
Yeah, and this becomes a very fraught conversation. Is this a template? Well, this is innovative financing. Well, can the Europeans come up with innovative financing, or is the bar going to be higher? I think the most interesting takeaway from this week has been that 15% is the new 10%, and 50% is very well adjusted by the market, adapted to, simply because certainty is better than really dealing just even with tariffs at this level.
We don't like policy volatility. We saw that through April. Don't like these self-imposed deadlines either. They're all over the place. And I think for the time being, they're not that important either. For the Chinese at the moment, mid-August is the next line in the sand. Secretary Bessent's already told us that doesn't matter anymore. He basically came on the programme again and doubled down on that. They're going to meet in Stockholm next week. kick the can just a little bit further down the road, and I think the market's comfortable with that idea too.
Yeah, so the question is just, does that really go for the other countries as well and the other regions? For the European Union, is that August 1st deadline ultimately fungible if you have some ongoing progress? Sort of the will they, won't they, the taco kind of question. It seems like this market's moved on. They're looking at 2026. And I think that increasingly we're going to have to try to understand how well companies really can map out consumers' response to this, the inflationary response to this, how their supply chains will adapt and adjust as we do face off with tariffs that are at their highest levels going back to the 1930s.
How many times have you said the economy's not the market's not the economy? Later, we've got a big name, Alphabet. Once you kick off Mag 7 earnings, we're talking about something very different. Microsoft, Amazon, Google, Apple, very different trends.
There has been a secular shift with investment in technology that some people say will be more revolutionary than the internet. And this has been fueling the optimism in equity markets. Have people been conflating that optimism that really is specific to a technological advancement with broader economic strength? And that, I think, is one of the key debates on Wall Street.
A fantastic lineup of conversations found only on Bloomberg Surveillance with Annmarie down in Washington, D.C. Thanks for watching this morning. Coming up tomorrow, Andrew Sheets of Morgan Stanley, Dan Ives of Wedbush, Libby Cantrell of PIMCO, and Pooja Kumra of TD Securities. From New York City, thank you for choosing Bloomberg TV. For our audience worldwide, this was Bloomberg Surveillance.